Hey guys, it's Jay. Welcome to the Special Situations Research YouTube channel. Our goal is to provide the best educational content available for you on investing and the capital markets. Here, you will find free educational materials on a variety of topics and asset classes, as well as recordings of our public Twitter spaces that cover broad macroeconomic strategy and market events. For our company asset allocation, with respect to cash, money markets, bonds, preferreds, and individual equities, and special asymmetric ideas around income, closed end fund arbitrage, value and growth stocks, merger arbitrage, spin offs, split offs, and dual class share arbitrage, visit our website at specialsitsresearch.com. Also, you can join our Discord for our weekly live idea focus events, some of which are shared on WebEx. Both the website and Discord, which is where we host live events, can be found in the description box below.
Hey everyone, thanks for tuning in. Enjoy the space.
Hey Jay.
Hey, how's it going? Wolf, how's your weekend going?
Very good, very nice. Been pretty calm. I've just been working a lot on the schedule spaces for the week. I'm actually doing all that posting now. How about yours?
Oh, awesome. It's been going well. Just a lot of work, reading, preparing for this coming week, but it's going pretty well. The weather was really nice this morning.
Yeah, it's a little muggy up here in the Northeast, but I'll take it over the cold any day of the week.
I'm just going to send you a co-host invite here.
I have till 7, by the way. I have to hop on a call at
That's
7.
perfect. That's perfect. I think we're going to go till about 8:30.
Yeah, Wolf, I just got in Texas a couple hours ago, so I'm enjoying this nice 96 degrees weather.
96. Yeah, it's peachy.
Well, I'm in Dallas. At least it's not underwater right now, so there's that benefit.
Thank God for that.
Hey guys, so we're gonna be starting up in about 3-4 minutes. Bear with me here, just getting my notes and topics uploaded to my iPad.
Sounds good. Yeah, I saw you got a lot of interest in this space. There were 415-ish reminder set, so that's pretty cool to see.
Absolutely. I did a collab last week with Ange Trades, and we talked about nuclear, and we talked about a few other really interesting topics that resonated. And I tend to be pretty selective in the types of investments, ideas, especially in this type of volatile economic climate that I tend to spend time on. Because in the end, right, all you really want is a return on time. Right? You don't want to spend time on stuff that is not going to be additive to your education or your portfolio. So spending time on, let's face it, bullshit tickers, companies that are going to zero, swing trades that you might make money on for like a couple hours, maybe not, that won't matter to you. I think is over time just I think it just causes more stress and causes just a big time sink and a dead weight loss for you. So so I think the topics that we touched on really resonated with people, and I'm going to spend some time on this call as well, going through, the different power markets in the U.S. What I think about the upcoming energy crisis, which is going to be a bigger crisis in Europe, but I do think that there's going to have to be a big change to the power infrastructure in the U.S. So I'm going to spend some time on that as well. So, I was happy to see it. I mean, the goal is just education. This is a free space. And I just think there are a couple of topics that resonated with people in the space we had earlier this week. But again, we're going to start up in a couple minutes.
Yeah, that sounds great. Definitely makes sense. Also, I don't know if this matters a lot for you. If you're doing several spaces throughout the week, I think they rolled this out to everybody. I'm not 100% sure, but after a year of me asking, Twitter Spaces has finally given us the ability to schedule multiple spaces at the same time. So I'm finally able to schedule, my Monday space, my Tuesday space, my Wednesday space, like my Friday space, and it doesn't have to be Thursday night when I schedule it. So it took them a year to
That's
do,
great.
but yeah, it's out. So that might be able to help you too.
No, that'd be great if you could if you could do that. And I have one of my former analysts in the audience at Vital Stock Market News. He doesn't cover every single news topic, but he does cover a lot of topics that he covered with me and that I think are important to understand when thinking about asset allocation, investing. So he's in the audience at Vital VTL stockmarketnews.com. So we're going to start at about 6:40, and the topics we're going to cover in this space are going to be why did the market sell off on Friday? What were the three economic or the examples that Powell shared at the end of his 8-minute speech that rattled capital markets participants? Who are the five Fed speakers this week? What do I expect? What do I expect from them? We're still at the end of earnings season, so there are a host of companies reporting next week, like Best Buy, that will reflect the strength of the consumer. There are also a lot of tech software companies and related businesses, Nutanix, MongoDB, companies in the tech space that still have to report. And we're also going to be spending some time on the debt market, the fixed income market, what happened with the yield curve last week, what it means, and where do we see credit spreads going, what asset classes to avoid, what asset classes are interesting. So just another 2 minutes and we'll roll from there.
Yeah, that definitely all sounds like good stuff to me to be covering. Are we going to cover the Fed pivot?
Yeah, you know what? I mean, listen, it's funny. The Fed will pivot at some point, right? One, when will they pivot is the first question. And two, what's the definition of the pivot, right? It's funny, a broken clock is right twice a day. So eventually all these people calling for a pivot will be right. I just don't think it's going to be in the immediate future.
Yeah.
So, we let, let's start in about a minute, and actually, we are going to have some guest speakers ask questions and participate as well. I don't want this to be one-sided, and if you have a question or you have a specific stock or an asset class that you would like to ask a question about, also feel free to jump in and ask anything. This is meant to be 100% educational. All right, so I have my notes up here. So what happened last week? Last week was a pivotal week, especially Friday. We had 160 billion of CTA buying from the middle of June through the end of July. That resulted in fueled, this 23% rally in the Nasdaq off the lows, almost twice the 13% bear market rally we saw from March to April. And, how should we be positioned now? So, bear market rallies are, again, pretty common. There were 7 bear market rallies in the 2002 to 2002 period. There are also several bear market rallies between between when the first two Bear Stearns hedge funds crashed in I believe it was July of 2007 through the European pigs crisis in Europe in 2011. So there's a lot of market volatility then. There's a lot of market volatility now. Nothing's really different except for the fact that I think the Fed's put is much lower than it was historically, and some of the geopolitical risks we have today. We always have geopolitical risks, but some of those geopolitical risks are more pronounced in this climate than they have been in the past. And then there's also a lot of misinformation. There's a lot of political back and forth because of the midterm elections. So you'll have politicians say one thing and do the other. Now you have Senator Warren lashing out, I believe, for the first time against Powell, saying that he's hiking too much. What's worse than inflation? It's inflation with higher employment. And I think that it's easy for people to criticize Powell at this point, but I think one thing that Warren forgets is that 6 months of interest rates at 3%, which isn't really that high compared to historical levels. I mean, look at the 2, 3, 4, 5, 10 year over the last 15 years. 3% isn't that much. I don't think we're going to see above 5% unemployment anytime through December. I think it would take something gargantuan or a very sharp slowdown in the economy that, based on the economic data right now, even if it continues to get worse, and the fact is that employment is a lagging indicator. I think that she's just catering to her followers when she says something like that. I almost think of her as like, her Twitter account kind of like, it's like the biased account of like of a super liberal, without getting too political, super liberal, grad out of college. And I think a lot of things she says aren't really based on any economic fundamentals or data or research. And you're going to see more and more politicians, especially going into the midterms, because the economy isn't going the way. And let's be real, on both sides of the political spectrum, whether you're a Democrat or a Republican, everyone takes credit when the economy is doing well, and no one takes credit when things are going poorly. Okay. And it doesn't matter what party you believe in. Those are the facts. So as we get closer to the midterm elections and things are volatile in the economy, people are losing their jobs, inflation is high, it's affecting the pocketbooks of the middle class, lower middle class. You're going to have more backlash against the Fed. But I was actually surprised and rather proud of Powell, given the euphoria we've seen in in markets and the pending energy volatility we could be seeing in the winter, that he actually stood up to the plate, and he provided three economic examples in the speech that we'll touch on now on Thursday, which really spooked the market. So the first lesson, you know, that Powell discussed, is that central banks can and should take responsibility for delivering low and stable inflation. Now, it may seem, and these are his words, now that central bankers and others once needed convincing on these two fronts, but as former Chairman Ben Bernanke has shown, both propositions were widely questioned during the Great Inflation period. Today, we regard these questions as settled. Our responsibility to deliver price stability is unconditional. And I think that this is when the market really started to turn. It is true that current high inflation is a global phenomenon, and that many economies around the world face inflation as high or higher than seen here in the United States. It is also true, in my view, that the current high inflation in the United States is the product of strong demand and constrained supply. It's not just supply. It's not just supply based, and you can see that from what I posted on my Twitter. Just taking a quick break here, and I'll post it in the thread, that within core CPI, 70% of core CPI, and this is from the Bureau of Labor Statistics. It's not my data. 70% is core services inflation. So this is what he's talking about, and it's only been going higher month over month, even with the lower CPI print last month. So going back to Powell's three-pronged example here in his 8-minute speech, it is also true, in my view, that the current high inflation in the United States is a product of strong demand, and that the Fed's tools work principally on aggregate demand. None of this diminishes the Federal Reserve's responsibility to carry out our assigned task of achieving price stability. There's a clear job to do monitoring demand to better align with supply. We're committed to doing that job. Okay. So here, he is being pretty steadfast, right? In the beginning of the speech, he did talk about the fact that the economy could slow. So it's not like he's ignoring that, but he's clearly sitting here that price stability is more important to him. The second lesson he talked about on Thursday, if you missed it, was that the public's expectations about future inflation can play an important role in setting the path of inflation over time. Today, by many measures, longer-term inflation expectations appear to remain well anchored. Okay, that's a risk for him. That is broadly true of surveys of households, businesses, and forecasters, and of market-based measures as well. But that is not grounds for complacency, with inflation having run well above our goal for some time. Okay, that's kind of the second point he made. If the public expects that inflation will remain low and stable over time, then absent major shocks, it likely will. Unfortunately, the same is true of expectations of high and volatile inflation. So during the 1970s, as inflation climbed, this is his example, not mine, the anticipation of high inflation became entrenched in the economic decision making of households and businesses. The more inflation rose, the more people came to expect it to remain high. And they built that belief into the wage and pricing decisions they made every day. As former chairman Paul Volcker put at the height of the Great Inflation in 1979, inflation feeds in part on itself. So part of the job of returning to a more stable and more productive economy must be breaking the grip of inflationary expectations. This is still his second example. And then finally, we're going to move on from this topic in a second. We'll go to the third lesson. But one useful insight into how inflation may affect expectations about its future path is based on the concept of rational inattention. When inflation is persistently high, households and businesses must pay close attention and incorporate inflation into their economic decision making on a daily basis. When inflation is low and stable, they are freer to focus their attention on other things. I mean, this is what I was discussing in my last space is, macro is only important at inflection points, right? When inflation is low, you don't need to worry about it. But when it's a constant part of your daily decision making, it becomes self fulfilling. Former Chairman Alan Greenspan put it in this way: for all practical purposes, price stability means that expected changes in the average price level are small enough and gradual enough that they don't materially enter business and household financial decisions. Okay, and that brought him to his final third lesson, which is that we must keep it this way until the job is done. And this is what I think 4 Federal Reserve members said before the Jackson Hole Symposium, that the thought that the Fed is going to raise rates and then cut them immediately in the first quarter is premature. And that was a big blow to the pivot bros, as I coined. Um, so he says history shows that employment costs of bringing down inflation are likely to increase with delay. He's saying that employment is going to show up, with a lag. As high inflation becomes more entrenched in wage and price setting, the successful Volcker disinflation in the 1980s followed multiple failed attempts. So what he's saying is multiple failed attempts to lower inflation over the past 15 years. He doesn't want to be in a situation where he raises and cuts and inflation comes back and you see wage pressure. And, I think he wants it to be clear and see several months of inflation coming down, not just because of year over year effects, and not just goods inflation, but wage inflation and other sticky inflation categories as well. A lengthy period of very restrictive monetary policy was ultimately needed to stem the high inflation and start the process of getting inflation down to low and stable levels that were the norm until the spring of last year. Our aim is to avoid that outcome by acting with resolve now. So that's a quick summary. And I think that, the market is, a lot of people were caught off guard. I know Warren called Powell the most dangerous man on the planet, but I think a lot of guys were caught off guard last week, and there likely will be follow through in the early. I would say, you're already looking at futures, small caps. Russell's down 1.3%, and Nasdaq's down about 1%, and SP's down 70 bips. Anything can happen overnight, but I do expect some follow through, given how many people I personally know in the fund space that are on vacation, and that are going to be coming back to work after Labor Day. So I think we had said, in some earlier pieces that we had shared with subscribers that, after the aggressive CTA buying and repositioning, and the fact that dealers were aggressively long gamma 2 weeks ago, that part of that should reverse. And going into the third quarter earnings season, guess what? We're ending second quarter earnings season, but we're already preparing for third quarter. By September 15th, about 51% of S&P 500 companies will enter a blackout window, which means that, many of them will not be able to buy their own stock. For many of these companies, they are the biggest buyers of stock. On average, buybacks are, roughly 3% of S&P earnings accretion. But, for some of these companies that aren't well followed, tend to be in the value sphere. The main buyer, incremental buyer, is the corporation itself. So it is something. It is something to keep in mind. And, fortunately for us, given the market rallied so sharply, there are a number of companies where you could hedge in a cheap way. So, some of the big tech companies, Google, believe it or not, is tied to advertising, right, which tends to be cyclical. If you're the CEO of a company, the 3 things you're going to cut in order to free up your budget, and improve your SG&A leverage, and ultimately your operating profit, are you're going to cut your advertising budget, right? You're going to cut your non-essential workers, your bottom 10% performers, right? And you're going to cut capex and stop signing new contracts, right? Those are the 3 things you're going to do, and those are the impacts you're going to see in the next couple quarters. So you're going to see the low end consumer continue to suffer, unfortunately, and you're going to see that, when Best Buy reports earnings next week. I believe, on Wednesday. You're going to see that when third quarter earnings you know come come through, and all the retail apparel appliers retailers report. You're going to see that in the back to school season, spending, and you're going to see that in the holiday season, where I think in the last holiday season, because everyone was getting together after COVID, after a year, spending was actually pretty decent. I think this time, retailers are going to be hit harder than one would think. And no company, I get DMs all the time about, what companies are safe. And, and I'll share a handful of companies I like. Some companies that I think are interesting because there's an activist involved, and valuations are getting more reasonable, like PayPal. Some companies like Salesforce, I think, are good businesses. Adobe, that I think are good businesses. But in reality, Autodesk, which is a good business, but in companies that generate actual free cash flow like Oracle, the issue is that no company is going to be very honest, which is one of the reasons why we have 55% cash at this time. So no company is going to be immune if we enter an economic cycle, right? Some companies will have lower beta because they generate cash, because they can return capital to shareholders, will be more immune to the volatility than others. But the truth of the matter is, this has been the worst year for companies in the past several years, for companies that can't generate free cash flow. And why is that? Like, why fundamentally do companies that don't generate cash flow underperform in monetary tightening environments? And the reason is very clear. It is a two-pronged reason. The first reason is you can't raise equity when the equity markets are moving around 3-4% a day, that are down 10, 20, 30% from the highs. Especially if you're a more speculative company, there's no way for you to raise equity at high prices in this type of environment. So if you don't generate free cash flow, how are you going to fund your growth? The second is, if the debt markets are not cooperating, and I think we shared this multiple times, but you can actually find this. The Federal Reserve actually publishes data from the Bank of America Merrill Lynch high yield index. You can actually track high yield spreads for free. You don't need a Bloomberg. So just put in your Google, and you can find it. But high yield spreads, essentially gapped from 200 to 600, back down to 400. Now they're 460. High yield spreads, I think, are going to gap out. And in the words of the head of CIO, the chief investment officer of JP Morgan last week, and by the way, didn't have to go out and say this, he thinks high yield spreads are at least going back to 600, if not much higher, over the next several months. And I'm surprised, Diamond even let him go out there and say something like that, because these guys are the biggest underwriters with Bank of America of high yield debt on the planet, right? So high yield spreads are going to widen out. In that type of environment where it's hard to raise money in the credit markets, most small cap companies, and companies that don't generate, not even small cap, mid cap companies like Carvana, right, that need to borrow from the high yield markets in order to fund themselves, right, they will not be able to raise debt at prices that are reasonable. There are some very good companies that I follow that have had to raise debt at 9 and 7/8, almost 10% in this type of rate environment. So going back to, if you follow a company, let's say we're randomly picking Fubo here, that spends so much money on content, right? Doesn't generate EBITDA, doesn't any reasonable amount of EBITDA, doesn't generate free cash flow, is burning several $100 million a year. They're not going to be able to raise money in the equity market, and they're not going to be able to raise money in the debt market. So that's why the market, a lot of these companies have sold off so much. It's not rocket science. It's just, just think about it. If you need to raise money and you can't raise money, your business model is not valuable, in a monetary tightening environment. So that is, the most simplified way to understand, what's going on in this environment, and why it could get worse if the Fed is focused on monetary tightening. The companies that need to raise capital, right? This is why, the biotechs, right? The biotechs got drilled. In fact, it was the past year and a half was the worst period for biotechs in my career. Probably one of the worst period of biotechs. Now, I don't cover them. I don't have a lot of exposure to them. And then from June to August was a huge snapback in biotechs. Why? Because the 10-year came down from 3.5% to 2.5%, 100 basis point compression in 3 weeks, probably one of the biggest snapbacks, right? And a lot of that was the fact that hedge fund managers were super short rates, right? There once it was a one-sided bet, and then that, there was a big snapback. Um, but since then, the 10-year Treasury has gapped back out from 2.5% from 3%, and a lot of these biotechs and unprofitable tech companies have sold off. I think a lot of people were kind of making fun of me with my, and I tend to have small hedges. I share them pretty openly with subscribers when I add, and I add like 50 bips at a time. The most I'll add is like 2% at a time. The biggest day was when I added 2% SARK, 2%, no, 2% S&P, 2% IWM, 2% Russell hedges when I already had my SARK hedge. And if you pull up, you pull up the graph of SQQ and SARK over the past, few days, it snapped back, and I think it will continue to benefit from monetary tightening over the next several weeks. So taking a break from that, let's talk about Europe, and then we'll talk about the power grid, how electricity is priced in the US, what are the different markets. We'll talk a little bit about nuclear, and if we have time, we'll touch on a couple special situations, like Twitter, for example, the Twitter spread, and what are the implications of the cyber expert, the former employee that was sacked in February, whether what he says constitutes an MIE, what is the stock, implying, from a probability of deal close perspective, and what we think about the judge overseeing the case. So, what's happening in Europe right now, I think, is even scarier than what is happening in the US. And to take a step back, the two biggest threats to the global economy today are the European energy crisis and the $60 trillion real estate time bomb in China that everyone keeps forgetting about, because it's not pertinent to us, or doesn't seem like it's pertinent to us in the US. So, what's going on in Europe right now, and what surprised us over the past couple weeks is that, we are in a situation where Nord Stream, the pipeline that sends gas from Russia to Europe, it's been shut off. And obviously, Putin is playing games. He's saying that it's a maintenance period, but he's probably seeing how much he can threaten Europe before Europe breaks. And last week, you saw the first Dutch city, and I posted this to my Twitter timeline, cave in and asked to be exempted from sanctions against Russia. And I think I think at some point, I don't know when, I don't think it's going to be from Ukraine. I think you're going to see some European countries push back on sanctions when there isn't enough energy to, for people to heat their homes. And it's unfortunate to come to that space, but natural gas prices are, 8 times more expensive there than there are here. The price to heat your home, 20 there are homes, 2-bedroom apartments that cost 2,400 GBP, British pounds, to heat, and to consume power, whereas that price was 90% lower 3 years ago. That type of price, what consumers view as price gouging, I think, is outside of the government's control. And, the government doesn't have the ability for unlimited subsidies. So I do think that, you are going to see you're going to see growing subsidies, but you're going to see some severe stress going into the winter, and no one can predict the weather. But we're looking at futures. Natty's at 950 right now, MMBTU. That is roughly 4 times the price of natural gas at this time of the year historically. And that's without the Freeport LNG export facility, which is 2.3 BCF per day, even on. Right now, multiply that by 10 and look at what's happening in Europe because of the low levels of the rivers in Europe. Right, the Danube River in France, the rivers in Germany. We are in a situation where they can't even deliver coal. You know, 8,000, 10,000 BTU thermal coal used for heating for coal power plants. They can't even deliver that across the Rhine in Germany. So, compound that with the fact that, Russia controls, they control, a lot of oil exports, and oil is essentially refined into distillates or diesel, and diesel and kerosene are used to fuel generators and to heat homes as well. So what's likely going to happen is that You're going to see increased demand for distillates, coal, anything outside of natural gas in Europe preparing for this energy crisis. And because Germany exports $800 billion a year of autos and heavy machinery, the third behind China and the U.S., much bigger than Japan. They will need to shut down industrial activity in order for to be enough energy for people to heat their homes. Just 2 months from now. At the same time, the SPR, the U.S. oil crude oil reserves, the three reasons why oil prices have fallen from the $130 a barrel peak when Angie and I were both fading the rally, was one, the China economic slowdown, two, the SPR, the fact that there are 7 million barrels a day hitting U.S. inventories every week that President Biden and you his administration help release in order to temper oil volatility. And three, there was essentially a decrease in expected transportation. Look at DOT, the Department of Transportation miles driven. You actually saw European travel snap back faster than did in the U.S. as U.S. consumers drive more and were more sensitive to gasoline prices. Going into the winter, those categories are going to be less. Those three drivers are going to be less relevant because one, we expect China to unleash further stimulus. They haven't. All their stimulus has been supply driven. We think now they're going to be announcing at some point some sort of a demand driven stimulus, given youth unemployment just hit 20%. The reason why China's been focused so much on supply-driven stimulus than demand-driven stimulus is they don't want rampant speculation and they don't want commodity prices to go up. But at some point, they'll realize that the $1 trillion that they announced on the supply side, the Chinese real estate market continues to fall. It is the biggest asset class in the world, 60 trillion. And we think that if they do announce a demand-side stimulus, it will put upward pressure on commodity prices as well, and that would be detrimental to Europe. Where Europe, because of the lack of infrastructure, because of the lack of regasification plants, right? They even have a limit on how much LNG that they can import from the U.S. because they don't have the infrastructure to convert it. And that leads us to, the power crisis and what the impact of the power crisis could be on inflation. There are several economic forecasting firms that are, forecasting double-digit inflation for Europe. And what this means is that, the European central bankers, the heads of the ECB, and governors like Kazakhs, Olli Rehn, over the past week, essentially said, and I posted this great little infographic, and I'll post it to the top. It shows kind of like the hawk dove graphic that a lot of media commentators use in the U.S. There's a hawk dove graphic for the ECB that I think will be useful who haven't focused on the European market. I do think the European market is going to be extremely important over the next 4 or 5 months when it comes to global capital markets and what's driving activity. But I'll share that to the top of the space in a second. But actually, let's take a quick break. And while I'm posting this to the top for everyone to see, I see AJ has his hand up, and then we'll go to Weimar. AJ, while I post this up to the top.
Yeah. Hey, thanks for hosting this, Jay. So one quick comment. You're talking about automotive sector in Europe, right? So, I mean, I work in the automotive industry right now. I cannot confirm names of what's going on, but what I do know is a lot of my suppliers and clients, which rolls back into various companies within Europe, have already cut back on their demands. They've already pushed out the contracts. They've already redone their pricing, and they're already incorporating shutdowns for periods of time in their production. Now, they're not announcing all of this publicly, which is why I can't state names until all that information comes out. But Jay, to your point, I'm already seeing it every day on my end because I'm working with the interface with those people out there, and like you said, I only think it's just starting because um, the uh, the demand of just running your operations day to day is astronomical, and you're just businesses were trying to survive in the beginning when these prices were going up, Jay, but now it's gone to the point where there's no light in the tunnel, so you have to now uh, build a plan where it's going to sustain at these levels for a quarter or more, right? So they are now starting to build that in on the back end, and I think as time goes on, the rest of the information will come out. So I can. That's really the comment I wanted to say.
So
Go
so
ahead.
obviously, in every type of space, when people lose money, they get very emotional. So the two worst things you can do to a guy on Twitter is to say that you're wrong, or provide an example, that's contrary to what they're saying. They go absolutely ballistic. But Weimar, you posted something really interesting on at the top of the space, where there's stockpiling happening in Europe. There are a lot of energy intensive materials, like aluminum, I think requires the most electricity out of any metal to produce. So, stockpiling aluminum and glass and other energy intensive commodities is something that we expect. Did you want to touch on it while uh
Yeah, sure. I
okay,
mean,
go
that
ahead.
was actually not even what I was going to bring up, and I also appreciate the fact that you're often contrary. So thank you for that. But zinc is another one too, and they're shutting down smelters. And if you recall, that market has, like nickel, come close to squeezing several times. So zinc will be interesting to watch in the coming months. But I wanted to call out. You mentioned youth unemployment in China, and I wanted to know if you knew more about that because I've been following that situation since last year, and they have a trend there called lying flat, and they try to downplay it and hide it now. But a lot of the youth there are actually opting out of the quote workforce due to kind of, like, I would call it like an ennui. Like, what's the point? I'll never get a house. I'll never get married. The wages are abysmal compared to what I can actually consume. And I wanted to know your thoughts on like demand stimulus kind of addressing that.
Yeah, so I think that the G and his political party is acutely aware of youth unemployment, but the reason why they haven't been able to address it, and why demand stimulus won't work in a vacuum, is that with all these lockdowns, like last week, there was another lockdown in part of Beijing, not Beijing proper, but on the margin, there was I think a suburb of Beijing that was shut down again. And these consistent lockdowns, and the fact that, China is the most populous country in the world outside of India, and, they don't have the same medical facilities and the same access to vaccines. We're not going to argue on whether the vaccines work or not, but they haven't been, they're the better way to say it is they're more sensitive to COVID outbreaks than we are. And because they're more sensitive, and because they were afflicted by the SARS affliction, when you had bird flu and avian flu, and this has been an issue for several decades in China. Even before this, like when I was in Japan, when I had colleagues go to Hong Kong, people will wear masks before we wore masks in the US. Like 10 years ago, 20 years ago, you go on a subway in China, you go on a train, people would already be wearing masks, right? So they've been very sensitive to this situation, even prior to COVID. And, you know, having a stimulus would be moot if, 10-20% of your country shut down anyway, right? Why would you announce a stimulus at that point when it's not really going to change anything because of your own direct policy directive? So I think this is why we are not super bullish on China. One, because you can never predict what the regulators are doing. They continue to regulate the tech industry, which is, I think, one of the only areas of the Chinese economy that I think are interesting to invest in. Um, and they're using tech companies as a piggy bank for social spending, because the government knows that that they can't just keep papering over every problem. Something we need to learn about in the U.S. And so what they're doing is, they're taxing tech, but that tech isn't responsible for a lot of these issues. So what they should be doing is, tax, like in the U.S., for example, with the education, with the student loan forgiveness. That's great. If people need help, they need help. But you should be taxing universities and endowments to pay for that. There should be a one-to-one, so that universities understand that they're part of the problem. In China, the government can just arbitrarily decide to tax whoever they want. And some of the directives are, they're not favorable to investors. So that's one thing we don't like about investing there, even though they are announcing stimulus. Two, there's been this zombie real estate market that people have been talking about since the early 2000s in secondary and tertiary cities, buildings of empty apartments. There are contractors now that aren't even getting paid because, you know, residents are afraid that some of these buildings will never be finished, and they're worried about the apathy of their government and the fact that there are all these lockdowns. They think the government doesn't care about them. So then these contractors aren't getting paid. They aren't paying the banks. And like about half of the trillion of stimulus that the government announced is actually going to paper over losses at banks and SOEs. It's not even going to affect the general public. So a long-winded answer to your question is that we think that, one, China's can't really focus on demand side stimulus until they're confident it's going to have a strong impact, and they're past a lot of these lockdowns. Two, I think that they're worried about causing inflation. So they don't. On the supply side, they're trying to do whatever they can to avoid a real estate collapse and it rippling through the economy. On on the demand side, they could do demand side stimulus, and one could argue there are a lot of things they could do on the demand side to increase speculation in real estate, but they also don't want, you know, to cut, to cut deposit requirements and things that would become problems, 5, 10 years from now. So they tend to be more disciplined when it comes to helicopter money. Um, it wouldn't make sense for them to encourage or to give subsidies to companies or to do anything on the demand side until these lockdowns stop. So they're kind of stuck in a situation where they're not going to be able to get out of it for several months. Just like Europe's stuck in the situation with energy, and until these sanctions don't go away, and I don't think the sanctions are frankly going to go away completely in Europe until for several years, because the Russians essentially killed 80,000 people in cold blood, um, and it's unforgivable, right? There's some estimates that it could cost $2 trillion to rebuild Ukraine from here. Right. So is Russia ever going to be on great terms with Europe? Probably not. Will the sanctions ease? Will some countries try to get out of it? Absolutely. But I don't think it's going to happen overnight. So hopefully, to the top, you guys can see, the infographic that shows, from the most dovish, Panetta, to the most hawkish, Holtzman, that last week ECB's Kazakhs, Ren, Nagel, and others are signaling for a 50 to 75 basis points hike in September. Now, that would be like the U.S. tightening rates 75 basis points into a into a huge recession, right? And we aren't even close to to the situation that Europe is in. Like the German GDP numbers, if it wasn't for the 2.3% government spending, they would have been down in the negatives, probably negative 1.5%, if it wasn't for the sharp increases in government spending. So, it's not just a U.S. crisis. I think this is a crisis that is starting to become a global crisis, and it's a global crisis at a point in time where, even though there is suffering on the European continent, these governors can't. They almost feel like they have no choice but to raise rates because of the Euro USD. And I'll post the Euro USD, and we've shared our insights into where Euro USD is going with our subscribers. But I think one of the obvious reasons why there's defense from the ECB and why they're going to raise rates into what could be a deep recession is that in January of this year, the euro is at 115, and today we are below parity. We are at 99. It is the lowest level in the euro, okay, since 2002. So basically, in 20 years, this is the lowest level that we've seen in the euro. And the thing is, because commodities are priced in euro, energy is priced in euros, okay? Um, if the euro were to collapse and go to 80 to the dollar, 85 to the dollar, what would happen to Europe is that inflation would ramp up even faster. So I think it's very important to understand that these European governors have no choice, and they showed that in their speech, especially last week when they were worried about Chairman Powell jawboning. In order to avoid a euro collapse, they have no choice but to raise rates and force their economy into the biggest recession since 2011, since the pigs crisis when I had to go to Spain and bail out cajas, Spanish banks that were lending to carnivals that were moving around, the worst underwriting I've seen in my entire life. When, Piraeus and, all these banks in Greece were blowing up, when these Portuguese banks were blowing up, right? Spain, Portugal, Greece, Ireland were, the focal point at that time. I think this time you are going to see Italy, with the number of hedge funds that I personally know short Italian sovereign debt, with Draghi leaving the government in Italy, the worry is that there's going to be no fiscal constraint in spending, and that the ECB's framework around buying sovereign debt does not allow the ECB to go outright and buy Italian sovereign debt at these high spread levels, even though that's what Lagarde said, right? So I think there's some hypocrisy. Not only there's hypocrisy in global politics, right? Lagarde wants the wants the markets to feel confident that the ECB is going to come in and bail out Italy, but their own construct will not allow them to bail out Italy until Italy, gets its fiscal house in order, which is now no longer possible now that Draghi resigned, right? So these political resignations you're seeing globally as politicians don't want to react to the inflationary issues, right? When things get tough, right? These politicians just end up resigning. They have these cushy jobs, right? They're not paid to take risk. They're not paid to make entrepreneurial decisions or come up with creative solutions to problems. What governments do today is they throw money at a problem. And that's what Italy's doing, right? We're no better than them, right? But the problem is that if Italy wants to get bailed out at a time where the European economy is slowing and entering an energy crisis, they're going to have to cut spending. According to the Europe, I'm not saying it's right or wrong. It's not for me to say, but according to the ECB's own construct. So we think that overall, this situation is going to get much worse in Europe for many reasons. And you look at Spain. Spain has $46 billion of exposure to Turkey. If you pull up the Turkish lira, it's free. Just go on Google and you pull up the Turkish lira. Istanbul, by the way, is a beautiful, beautiful city, and I love the Turkish, people. It's just that their government, the person who's running their government, I think is a nut job. And I think many would agree. But I'm going to post the Turkish lira up here just to guide the conversation. But we are at 18.2 to the dollar today. What does that mean? The Turkish lira has depreciated, okay, from September of last year. It has gone from 8 to 18. I think it can go over 30 by over the next 2 years, because Turkey is a big importer of energy, and just like Europe, they are suffering. And I think that until that during the winter, the Turkish lira will be at risk. And because Spain, Spanish banks own $46 billion of Turkish debt. I'm just going to post this to the top so everyone can see it. And for people who are not familiar with the topic, it doesn't look like I'm just talking to myself. But what happens when you have debt payments that are owed in another currency? So a lot of the big sovereign debt crisis we've seen, and Egypt might be going through one. Look at where Egyptian bonds are trading today. When you have U.S. denominated debt or euro denominated debt, and your currency falls much faster than or relative to the currency that the debt is denominated in, you actually have to pay more in interest and principal to pay that debt back in the denominated currency. So if you have debt denominated in euros at a bank in Spain, okay, and the Turkish lira depreciates, from 8 to 18, okay, red flags are going off, at the credit underwriters at the bank. They're freaking out, right? Then that goes from 18 to 30. You're worried, are you ever going to get paid back on this debt? So what do? You start accelerating on the debt. You do the absolute wrong thing. You say, hey, I want my money back. I don't think I'm going to get paid back. You guys breached this covenant. We want to get paid back. And it causes the economic situation to get much worse. So what we're seeing right now is there's some red flags in Turkey, there are red flags in Pakistan, there are red flags in Germany. This is not just an energy crisis. The biggest input into fertilizer prices is actually natural gas, into nitrogenous fertilizers. So if we see natural gas prices remain elevated for the next several months, I do think at some point, prices will come down next year. But at least going into the high demand periods, with natural gas, you have shoulder seasons. So the spring and fall, there's lower demand, and then the summer and the winter, there's very high demand. the spikes and the mismatches between supply and demand can get very pronounced when you're not in shoulder season. So that doesn't prevent, it, when it comes to agriculture and when it comes to food, right? That's not how those markets work. So if the price of fertilizer spikes very sharply, over the next several months, it's going to have further implications on food supply chains. So we have been, we took the opportunity actually, to position, if you look at the droughts in China, India, US, and I think Andrew's going to do space on water where we'll participate. So I'm not going to spend a lot of time on it now. We are going to, we were actually buying a little bit of the dip when it comes to wheat and corn after the precipitous sell-off that was driven by the Ukraine and Russia crisis. Because, most of that, when Ukraine said they were open and the first exports, were sent, the market had essentially fully priced in that, that there were no issues in the in the grains market, and we think that that is premature. So, we're coming full circle now. We started to talk about, the Fed, and we took a full circle. We talked about the energy crisis. We talked about China. We talked about energy. We talked about energy's implication on food, and now we're back at inflation, back at the Fed. So we're going to take a break from this topic, and we're going to talk about earnings next week. So we're at the end of the close to the end of the U.S. earnings cycle, but next week we are going to see a number of companies report, and just so that you guys know, there's been a demand. It's been an incoming demand. But we have a newsletter, we have subscribers, we publish on macro, special situations, closed-end fund ARB, dual class share ARB, mergers, the most interesting up-down scenarios for merger ARB. And is in NAV specs, we've been one of the biggest shorters of zero revenue, zero earnings companies in the SPAC space. It delivered a lot of alpha over the first quarter, and those opportunities are very obvious now as well. But we are also creating a Discord that has like live news feeds, more timely when I make a trade or when I have an idea, more timely and deeper insight than I can just put on Twitter because it's easier on that platform. And all the spaces that we have been publishing, we have been able to get downloads from the Twitter archive to essentially record them and provide them on through the Discord platform. And Discord also now has live spaces, so we will be providing live spaces more frequently for subscribers. But going back to earnings, and our Discords are going to be focused less on macro, more on like the event opportunities and trade opportunities and earnings. This coming week, these are the companies we're going to be monitoring. Heiko is a company that we monitor because of a DSPAC that we've done very well in called AirSale, which is ASLE. It was an idea we had last year, aftermarkets, aero parts, and MRO. When you have older planes, right, and you're building up inventories of those, this company buys up those parts. AirSale breaks up the parts and sells them. It does cargo plane conversions as well, converts old passenger planes into cargo vessels. This is an interesting cash flowing business run by some two key executives at AerCap, which is a multi-billion-dollar aircraft lessor. One of their competitors that actually creates that essentially manufactures and sells aerospace products and services through subsidiaries is called Heiko, HEI. So we're going to be looking at it. Not that we have a position in Heiko, we monitor Heiko because it's a competitor, and a lot of the supply demand drivers can be seen in that company's stock, and that's HEI. They're reporting on Monday after the close. There is on Tuesday, we're going to be looking at Best Buy. Best Buy is an electronics retailer, both online and in person. In the U.S., they are reporting pre-market on Tuesday. It's not to be confused with Bed Bath and Beyond because of similar tickers. This is BBY, not triple BY. The company has been fairly resilient, but we think that a lot of their products were pandemic beneficiaries, right? So how many computers do you need, right, for your work for home setup, right? How many TVs do you need? How many soundbars do you need? We think that consensus expectations are too generous, that sales are going to be down 10% next year. We think that this could be a company that may not see its peak 51 billion in in revenue for 2-3 years, and especially if you go into an economic slowdown. This is about a $20 billion enterprise value. What's good for this company right now is relatively low debt, 3.9 billion of debt versus 2.8 billion of EBITDA, so it's less than 2 times levered. But its free cash flow is light. We're going to do about 900 million of free cash flow, which we think is going to be declining. And I'm going to be looking at this company to see the strength of the. Also on Tuesday we have Baidu. Baidu is one of the big Chinese internet companies. This company got a snapback last week. We saw KWeb rally. You can look at the charts: KWeb, Baidu, Baba, JD, PDD. All the Chinese tech companies rallied last week because of there's news out that the U.S. is getting closer to working on essentially the Chinese requirements for what they disclose in public filings when it comes to the delisting issue that's been a big issue. So that's why it rallied. I don't have a position right now, but it is one of the biggest Chinese companies in the world. So I will be looking at earnings to see what they report. This is a company that had an impressive cost reduction over the last quarter. So even though we don't have a position, it's a company maybe next year, if it were to get really cheap, they've been showing cost discipline. They have a big robotaxi division, which essentially is kind of think about like an Uber that had been burning a lot of cash from them. So if they were to be more cost disciplined, that would make the company's business more attractive. It's one of the few companies in China that has made a lot of headway in autonomous driving. They call it the Apollo Go program, which operates in 10 cities in China. So they have, I think they have done, I think Apollo Go completed over 200,000 rides in the second quarter. They actually have 55 autonomous cars running right now without human control, all around Beijing's Yizhuang district. So it's a cool company that we monitor. We just have no position because of our views on China right now. Futu is another company that is reporting next week. It is kind of like China's discount broker. China, it is, not actually based in China. It serves customers in the U.S., China, and Hong Kong, kind of like Tiger, TIGR. It was one of the beam stocks. This was a stock that was up several 100% during COVID, obviously, because people are staying at home and trading. Reached 200 and kind of retraced all the way down to 40. It's something we just track to look at, what trading levels are, and at some point, it was a stock that a lot of individual investors had spent some time on, but the company still continues to have pretty robust margins. It has an 85% gross margin, 42% EBITDA margin. Free cash flow conversion is pretty high. Do about 3 billion of free cash flow, so it's above an 80% free cash flow conversion of EBITDA because they don't really have a lot of costs. It's just something we monitor, not that we have any position in it. Then we have Bank of Montreal. So why we are interested in Bank of Montreal, BMO Corp, BMO is the ticker, is that this is one of the biggest Canadian banks. And the Canadian real estate market, although even if Canadian real estate prices were to fall 40%, I don't think the banks would be at risk. But there are some secondary, tertiary effects to the banking system. I would say there's a large percentage of Canadian mortgages that are floating rate. And in one survey I was reading, 1 out of 5, or about 19% of Canadian home buyers were saying that at today's interest rates, if their mortgage were to reset, they wouldn't be able to afford their mortgage. So that's an important thing that we're monitoring. Canadian real estate prices were down 6.6% in May, 5% in August. 5% in June. They're down in July. I don't have the August numbers, but I think that this is a train wreck, and you could see, Canadian real estate prices down 20-25% by the end of this year. So the reason why I'm looking at Bank of Montreal, which is reporting on Tuesday, is that we want to see what they have to say, if anything, about residential real estate and the economic strength in Canada, which is our neighbor and a NAFTA partner. We also have CrowdStrike. CrowdStrike is reporting on Tuesday. CrowdStrike is a company that in the long term has some interesting tailwinds. It provides cybersecurity products and services to stop breaches. They have a cloud delivered protection program for institutions across endpoints. They also provide security for identity and data, cloud workloads, threat intelligence, managed security services, threat hunting, zero trust identity protection. So it's one of the leaders in cybersecurity in the U.S. We think that cybersecurity is a sector that is going to have continued importance, and it's going to continue to grow revenue over the next several years. The only issue is that this company is trading at 100 times EBITDA, and 90 times 2024 EBITDA. It's a $44 billion enterprise value with only 2 billion of revenue in 2023. So they have an interesting fiscal year end, which ends in January. So that throws off when you're looking at their financials, comparing them with other companies. But it's a fairly rich valuation, 22 times sales. So this is a company that sold off $8 on Friday. We would love to get involved, under 100, whether it happens or doesn't happen. Either that or when there is some sort of a pivot. It's a company that we have in our watch list, but it's not, because of its low free cash flow conversion, it's not high on our watch list. But it is something, because we love cybersecurity, that we monitor. Another company that is reporting next week that I think a lot of individuals are going to be interested in is Chewy, right? No one's going to get rid of their pets. It was a pandemic beneficiary, right? It is a pandemic beneficiary product, but a lot of the products it sells are recurring revenue products, right? Pet food, pet health, pet treats, pet supplies, healthcare products for dogs, cats, fish, bird, horses, reptiles, right? This is a company that this is where the meme lord of GameStop, right? This is where he made most of his wealth, right? In the turnaround of Chewy. So we don't necessarily love it here. It's a $16 billion market cap. It has a net cash position, so actually it's more cash than debt. So it's a $15.8 billion enterprise value, and it's trading at like 1.5 times sales. There's 10 billion top line, 2.7 billion of gross profit, so roughly 6 times gross profit. But it generates almost no EBITDA, right? Did about 50 million of LTM. This is not, and it burns cash slightly. This is not an environment that rewards low cash flow companies. So this is a company we have on our watch list. If this were to get to 25, my there's a bell in my head that's going to be ringing, and I would love, that's kind of where it was at the lows in May. But this company actually, if you look at their earnings, they've been relatively resilient, and the company continues to grow at double digits. So this is one that if it were to sell off, we would be interested, because obviously no one's getting rid of their pets. So one of the internet names that we have. HBQ, another pandemic beneficiary, but they obviously have some business to business exposure as well, which is less volatile. But we think that business spending is going to come down as well, so we're not super constructive on HBQ. HBQ is more interesting from a valuation perspective. It's a $38 billion enterprise value that does 6 billion. That's going to do 6 billion in EBITDA this year. So it's not terribly expensive, and its free cash flow conversion is relatively high. So for that 6.3 billion in EBITDA, we expect them to do 4.8 billion in free cash. The issue is that we think that it is a lot of the inputs into this company, a lot of the segments were pandemic beneficiaries. So we think that it is operating at peak revenue, peak EBITDA, at least for the near term. Until the company can prove otherwise, we're not going to be super interested in it. But just for those who are interested, the free cash flow to equity, at 4.8 billion of free cash flow on a $32 billion market cap, is roughly a 15% free cash flow yield. At some point, we will take another look at HP on a free cash flow yield, because they have the ability to continue to announce share buybacks and return capital to shareholders. Just not super interesting right now. And you'll hear me say that a lot, and they'll say, why is this guy saying that so much? It's because I think we're entering slow growth / potential recession while the Fed is tightening. So I would say, 2 out of 3 companies I talk about, I'm not going to be as excited about. So Wednesday, Express, we're looking at Express just for its strength of the consumer. It's also been a meme stock because it has a high short interest. One thing for people to understand, don't you realize that a lot of these meme stocks tend to be companies that shouldn't be doing well right now, like Express, for example, right? The lower end consumer, teenagers, getting allowances, spending money, right? They're not going to be blowing, their paychecks on clothes when they're having trouble buying food with their friends, right? So it's something to keep in mind. But a lot of the meme stocks, right, like Bed Bath and Beyond, which if it weren't for that $300 million loan that JP Morgan helped them put together, had a high probability of going bankrupt. Revlon, which frankly is bankrupt, and the judge literally said last week that the equity committee, he doesn't want, funds from the estate going to sponsor an equity committee because he thinks there arguably isn't any equity value. That's been one, right? And I have nothing against these memes, but like even WBR, I'm nothing against the company, no position. I wouldn't even short it because the short interest is so high. But who's going to be buying a grill after the pandemic, right? I already have three grills. Why do I need another grill, right? So a lot of the companies that do become memes, there's a reason why the short interest is so high. So in the first place, so they can run because if you get enough people, I'm not even saying that anyone should, and nothing here is financial advice, but these companies, if they have very high short interest and you gamma squeeze them and you buy weekly options and you force people to cover their shorts, obviously they'll have short-term runs. That doesn't mean they're good businesses or that your thesis is going to play out over 6 months, 12 months, 18 months, 24 months. So just a public service announcement. But we're monitoring Express to see what the strength of the consumer is. And then you have Nutanix. Nutanix has been, I call it a value tech name. I don't know if you guys follow uh, unsarcastic Russian, but he's a cool account. I think his day job is in software sales. But this is a name that tends to be one of the cheaper like turnaround stories in the enterprise cloud software space. They do virtualization, storage, integrated solutions. The reason why I'm not that excited about it, even after I think this is, if you look at the chart, I mean, this is a monster sell-off. This is, $45 stock. It was at 15 in July, and it's now, it was at almost 20, retraced to 18, is that it doesn't have any profitability. And while it is a turnaround story, company that does negative 300 million of EBITDA and improved it to negative 30, I think that's great. 38, that's great. And this would have been a home run if its tech peers were trading at the valuations they were trading at in 2021. I would be loading up. But as the entire software space has re-rated, I would rather wait until it's clear that we have an inflection point to buy a company that arguably is a turnaround story, but is generating negative earnings. But I am going to be monitoring earnings pretty closely for you, renewable geeks out there. There, we're still on Wednesday earnings. There's a company that I think many will be interested in. 1 second, let me just get my iPad notes. Computer is freezing. It's a, we'll get back to that one in a second. But on Wednesday, we also have Sentinel One and Pure Storage. So Sentinel One is another cybersecurity company. If you've noticed, companies in the same industry tend to report close to the same time. Sentinel One is another great business that we will eventually take a stake in. It is in the cybersecurity space. It's US based in Mountain View. The issue is that this is a $6 billion enterprise value burning $200 million a year, and it's trading at like 15 times sales. So I would love to buy Sentinel One at $15 because the long-term tailwinds are there. This is a company just like CrowdStrike. It's going to be growing top line at 50, 100. This company is expected to grow top line at 98% this year, 64% next year. Maybe the numbers come slightly lighter than that, but the tailwinds are certainly there. And at some point, we'll come back. And it's on our, we're adding names to our growth list. The first tech names that were on our list, for buying in 2023 were kind of the big free cash flow generators. But we are putting together a secondary list of companies that have the ability of free cash flow, but they're still in their growth phase. And they're oligopolistic, which means that there are two or three major players in the space that are taking all the share. So this is one of the companies that's going on the list for that. Friday, there are actually not that many companies reporting. So this is the last for earnings. And we're going to switch topics to energy and the electric power grid and how to understand electricity markets in the US. And before we go that, we'll go to Isher with questions. But on Thursday, we have Campbell Soup. So one thing that I've been reading in research is that more consumers are switching to private label. In fact, one of the reasons 52% of Walmart sales are actually food, believe it or not. And one of the reasons why Walmart originally guided to negative 13, 14% sales growth, and then came out during the quarter and was like 9 to 11, and everyone like everyone jumped out of their chairs and they're like, your earnings is only gonna be down 9 to 11%. It's funny how these companies, how at earnings you could go from, pre-announcing negative, 13, 14%, to negative 10, 11, and everyone thinks the problems are over. But anyway, Walmart is a good company, but what they said is that higher income consumers are switching to Amazon, switching to Walmart, and they're buying cheaper products and private label products. So I think Campbell, while the stock has done really well this year, I think Campbell, Kraft Heinz, General Mills are going to lose market share to private label in an inflationary environment. You also have Hormel Foods, HRL reporting on Friday. You also have Toro, TTC. You know, Toro is the company that we've never had a position in, but it designs, manufactures, and markets turf equipment, turf maintenance, agricultural irrigation systems, landscaping equipment, residential yard products. When it comes to the housing sector, it's just something that we're going to go through the earnings transcript and see if there's anything interesting. Signet Jewelers, SIG, the higher end consumer, as we saw in Capri, Michael Kors earnings, is less exposed to inflation. They're more exposed to market vol, to be very frank. We saw that in 2008, 2009. Even the higher end consumers were impacted. But when it comes to Signet, I'd love to see what they report in earnings. I'd love to see if their earnings trends are similar to Capri, Michael Kors, and whether my thesis is right, because I am often wrong, and that's why I tend to follow the data so closely. Sienna is also reporting on Thursday. They do market communications network platform software. They also do some consulting. Private. This business is frankly pretty cheap relative to other tech companies. 7 billion of sales, 4 billion, 7 billion of enterprise value, 4 billion sales, 500 million EBITDA. I just think that this company isn't a monopoly or an oligopoly, or doesn't really have an edge from what I understand. Um, they do have like these optical transport and switching equipment business segments that I think are interesting, and you will see growth because of the rising demands of video, data, and voice traffic online. And about 60% of sales are to US customers, which is positive. But a lot of these tech companies, just take a step back, are going to see big earnings translation hits in the third quarter because of the declining euro and the stronger dollar. So 40% of sales in the S&P 500 actually come from overseas, and it's weighted towards tech. So a lot of these tech companies, like even the Microsofts and the Salesforces of the world, are going to see declining earnings growth because of the stronger dollar, and a lot of their customers are paying in other currencies, and you can't 100% hedge that exposure. So other big kahunas that are reporting on Thursday, and we'll wrap up the earnings part of this segment. One is Broadcom. Broadcom is AVGO. It's a company I've invested in the past. It's not a company that I'm invested in now. But Broadcom designs, develops, and supplies semiconductor and infrastructure software solutions. We think that the entire semi business, whether it's controllers, network processors, chips, you're already seeing that. Like, read the earnings from Taiwan Semi, and while earnings for this quarter weren't that bad, you know, I'm sure a lot of you guys were on Nvidia's call. A lot of these companies, their 2Q wasn't that bad, but you are seeing inventories build up in the semiconductor supply chain, as some of these supply chain issues are going away. And as those inventories build, their pricing power will erode. And semiconductors have been a cyclical industry for the last 2 decades. It's not a new phenomenon. While they might be a little bit less cyclical because of demand and the increased electronics in cars. Same thing can be said for copper. When you think about the copper wiring and 1600 semiconductor chips in every new car, whether it's an EV or not, the issue is that they're still cyclical. And if we go into recession while inventories are building, these companies shouldn't be valued at several times sales. Those valuations should come down to earth. It doesn't mean they're bad businesses. I think Broadcom's a great business. I think Nvidia is a great business. I think AMD is a great business. I even think Intel's a great business, even though it's blowing 70, 80 billion on CapEx. All these are good businesses. There's just the time to buy them is not at the end of an economic cycle when inventories are starting to build. There might be better opportunities to get exposure. And then, Lululemon's reporting. Lulu, obviously, now for men and for women, see a lot of men in finance wearing those Lululemon stretchy pants. You know who you are, fellas. I don't own any pairs, so I can't say whether I like them or not. But I have seen them, on Wall Street. A lot of people have started wearing them even outside of fitness. It's a $40 billion enterprise value, 7.7 billion in sales. It's an expensive business, but 2 billion of EBITDA, roughly 20 times EBITDA business. So for retail apparel, direct to consumer apparel, it's rich, but it is a decent business. So on a big sell off, under 225, it would be something that we would want to, depending on the data, depending on earnings, to buy into. So that's the earnings component. I see Isher had a question, and then Captain had a question. We're gonna take a break before we go to the next topic on electricity markets and see what Isher and Captain have to say.
Hey Jay, thanks for the space. I have one suggestion and one question. Suggestion is just like we can all expect that there could be a big leg down right now. So I would suggest, with my small experience, that don't don't ignore what all the all the speakers and all the prominent space holders are telling you not to do. So things which they are screaming out of their lungs to avoid, please avoid them, and don't fight them, and don't be a cult member. And my question is on housing, Jay, what for Toll Brothers, Lennar, and DHI? What's your thanks, man?
Yeah, absolutely. So unfortunately, we covered our shorts too soon. But several months ago, just on a personal level, I was short the XHB Spider S&P Home Builders ETF, and some of the just given when mortgage rates rise, if you've been in any other cycle, um, you know there tends to be less home buying activity, right? So this ETF isn't perfect, but it has Williams Sonoma, it has Lennox, it has um, but it has the home builders as well, right? Outside of the Lowe's and some of the non-home builder companies, right? It has DR Horton, Lennar, NVR, Pulte, Toll Brothers, and Toll Brothers reported earnings very recently. I believe it was on the 24th of August. They reported earnings, and I thought that overall, it was a relatively negative earnings call. But if you look at the price action of Toll Brothers on the 24th, let's just go back. I would say that the market interpreted that their earnings as being less bad and favorable, and this actually rallied from 45 to almost 48 before selling off to 46 on Friday, like everything else. But Toll Brothers tends to be like kind of the mid to high level uh, of a home, so it's not like very cheap starter homes. They tend to be you know several hundred thousand. They tend to be higher quality communities. But I personally expect Toll Brothers going forward, so through 2023, to underperform peers from a sales standpoint through the housing downturn, given that it has less affordable products and positioning and less buyer willingness for this length of the build cycle. It also takes much longer when you buy a home for Toll Brothers from start to finish. And if I were a home buyer, I would just wait, say, hey, if I think that, if rates are going to come back down by 2024, why not wait to just buy a home then when I could probably get the home cheaper and rates are lower. So I think when it's not your starter home, I think Toll I think management stated that they're forecasting about, and the sell side also expects between 8,800 and 9,000 deliveries in 23, down from 10,000 in FY22. So it's not like the market is completely oblivious, and the market thinks that the deliveries are going to go up. But I personally think that that year to date the company's only sold like 6,600 homes. And I think that the pace of home selling is going to slow down pretty sharply. In 2023, I would go under on the street at 8,800 deliveries. Maybe it's 7,000, but I think the market doesn't understand the lasting impact of increased mortgage rates on on the consumer, and especially as prices start to come down. Like if you remember 2008, after Lehman Brothers collapsed, it took 3 years for property prices to bottom. It wasn't until 2012, 2013 that I started investing in multifamily properties. It took 3 years for prices to bottom and for foreclosures to exit the system. And we've had a big foreclosure moratorium. So this is not the same as 2008, but I would not be, even though it looks cheap, a lot of these companies look really cheap on earnings because, you know, they've sold off and the earnings estimates haven't come down a lot and the street is behind on that. So I wouldn't be terribly excited. On big rallies, I would be shorting the home builders. It's not, it's my personal, what I do personally. Doesn't mean that you have to do that. But it's just something that I've done research on. So hopefully that answers your question. And Captain, you were next.
Hey everyone. Hey Jay. Good evening. Thank
Good
you as
evening.
always for the space. World class. Really, the best out there. So I was going to ask about Sentinel One, but you already got that for me. Thank you. I'm with you on that. My next, I guess I'll follow up with another question. I'm thinking about playing SQQQ. I'm just not crazy about the time decay aspect of it. I was wondering if you had anything similar to, instead of shorting actual stocks, to have something like an SQQQ without the time decay. And also quickly, if I can follow up 2 seconds with your price target on SMR entry, I'd appreciate it. Thank you again, as always, man. Really.
Sure. I think you had three different questions. I think I think agree on Sentinel One. It's a great company, but it's a wait. It's a wait and see because I think in the beginning of the space, I talked about why buying companies without meaningful earnings and free cash flow is an underperforming strategy for 2022. Um, because of the fact that equity markets and credit markets are closed and these valuations will come down, continue to come down until they can prove the ability to generate that cash flow regardless of growth. But I do think it's an excellent company, and when the environment changes and as they grow and and get to profitability break even, it's a less risky trade at that point. But it's a company that I think has a defensible long term um, business model. When it comes to your question on SMR, we'll get to nuclear in a second, so maybe I'll save it. But just to be very clear, I have sold out in my position. I do think it was a great position where, there are actually a lot of companies that you can buy. The SPAC space is kind of full of corruption. It's full of sponsors that are greedy and they're getting paid in equity. It's full of underwriters that you've never heard of, small cap banks. But every now and then there are some really great companies that come out. One example is Target Hospitality, which is the largest provider of government remote accommodations, long-term contract living arrangements in the United States. And it also provides living arrangements for workers who are away from their homes and working on energy pipelines and infrastructure. And they provide full service food, hotel quality accommodations. And it has a 27% IRR, 4.5 year payback. Nobody believed in the stock because there's very few people on the sell side that actually focus on SPACs. But AirSale, the aircraft parts company I told you that I mentioned, that was run by former stars at AirCap. And this one, Target Hospitality, the warrants were literally up 1,000% in the last 2 months, and the stock has been almost a triple. So there are some decent companies in the space, and SMR, not because of its ability to generate free cash flow. For example, Target Hospitality still trades at like 4 times cash flow. It also has almost 10% bonds for the credit guys in the space. I no longer have any position, by the way, but after the run. But SMR is a company that we like because the DOE, the Department of Energy, gave them, an approval to essentially they have a 7 year head start to build small modular nuclear plants. These are nuclear reactors that can fit into a backpack where you can transport the parts on a locomotive, um, and the blast radius is under a couple miles. So this is, I think, a breakthrough technology. They're building one. I think they're trying to build one with the Utah utility. and they are in the process of building one in Eastern Europe. The reason why I took advantage of such a big rally and actually sold it earlier before even got here, but is that it was almost a risk-free trade where you could buy it at trust, where there was a floor because these SPACs are only allowed to invest in 6-month treasuries or money market securities. You could actually, when I was essentially publishing on it, and my team was doing work on it, you could essentially bought it almost at $10, right? Where you had very minimal downside. And if the company had actually already raised financing prior to even being a SPAC, so it had enough liquidity to operate for 3-4 years before it would need to raise capital. So, we believe that the technology is really compelling, but it is, like I said, this falls into a non-cash flow producing company. So kind of like Sentinel-1 and CrowdStrike, I think that like cybersecurity, nuclear is also the future. You're going to see significant breakthroughs. But the way that I'm playing nuclear right now is by buying physical uranium through two different closed-end funds. And, I'm waiting for a broader market sell-off to buy individual nuclear companies. And with SMR, I don't have a price target, but I'd be really interested back under 12, given, what the capital markets are doing. But it's very
Hey,
hard to have a price target on something that
hey,
doesn't
hey,
really generate EBITDA. Go ahead.
hey, Jay. What ETFs do you use for physical uranium? Thanks.
Sure. I use the Sprott Uranium ETF out of Canada. You know, I actually just buy the Canadian shares, but there's also US ticker. It's called SRUUF. None of this is financial advice, but the reason why I like the Canadian ticker better is that there's more liquidity. I think SRUUF you can buy out of any US brokerage, but I think it trades on average like 500,000 shares a day. Whereas I believe UUN, let me just pull up the volume so that you guys understand how I think about things. And you can look this up. You can pull up the prospectus and read it for yourselves. Sprott has a number of products. I'm not affiliated with Sprott. I actually don't agree with everything they say about silver and gold. Oftentimes, I think they tend to be too bullish on those things. But you can also interestingly track the Sprott products NAV. I tend to buy them when they trade at big discounts to net asset value. So they'll actually disclose like this is how many pounds of uranium we hold. This is the price. And if the fund trades below that price, there's like an arbitrage component there as well. So UUCN on Bloomberg, if you have it, this trades closer to 2.5 million shares a day. So I know that there's some like FX people, but will say, but this is a long-term thing for me. I think that, because Canada's a NAFTA member, over time, I don't they benefit from uh immigration and their relationship with the US, and overall it's a decent economy. They'll actually benefit from this energy shortage as well over time, despite some of the real estate hiccups that I don't really care about buying the Canadian shares. So I buy the U-U if you're looking on Bloomberg, or U.UN if you're buying through a brokerage. Whereas you can buy SRUUF in the US after doing your own work and reading the prospectus on the Sprott website. I also have added exposure, and I've written about this on my website, specialistsresearch.com. Yellowcake is listed in the UK. YCA is the ticker. It actually at one point was trading at almost a 25% discount to net asset value. And this is another one. It's a smaller market cap, so I would prefer, if you could pick one, I would prefer Sprott to YCA. YCA is also a lot less liquid. In terms of the number of shares, it trades every day. It's about 1.5 million, so it's about 60% as liquid as the Sprott Canadian shares. So those are the two ways I'm playing it. There's also CCJ, there's URNM. There are a lot of other ways to play it. I have my own personal biases. I think that the physical is going to be less volatile in this type of equity market, and the best time to buy miners is after the market kind of sells off a bit more. But hopefully that's helpful to you.
Thank you. And if I may quickly with SMR, I saw a bunch of call options at $18, so I don't think it's going to be going above that. Thank you again.
Absolutely. I think LV had his hands up, and then Darren.
Hey Jay, thanks so much. Um, so today's been a big Twitter Spaces day for me. One I wanted to like zero in on and ask you about was Michael Belkin's take on the long end of the Treasury curve, or the yield curve that is, and basically saying the TLT is making a sincere bottom, and that near term, a lot of appreciation or rally and the long end. Nancy Davis kind of calling Powell's hawkishness as well, and maybe echoing Michael's
Yeah.
thesis.
I mean, how do you think about biases? I love Nancy Davis personally. She's a Goldman alumnus, and will only say positive things about Nancy. But think about the product that she has and the ETFs. They look at inflation break evens, right? So those ETFs have underperformed a lot, right? And that hasn't, the thesis hasn't played out because long-term inflation expectations, five year is at 2.56%, and then some other people will say, well, look at the CBOE expectations for Fed cuts in the first quarter of 2023, and they weren't really affected at all by Powell's speech. They're almost the same as where they were before the speech. And prior to this, several months ago, when the 10-year hit 3.5%, I actually was a huge buyer of TLT. Was actually very vocal about it on Twitter. A number of guys, got some of the insights on for free. I would say we do produce a lot of free content that we explained our reasoning for that as well online. And I think with subscribers, they got access to a huge exposure to three municipal closed-end funds that actually outperformed TLT on the upside, where you're taking muni risk of states that were at the higher end of the echelon of U.S. states where they have low deficits, like lower deficits like Ohio, where those munis rallied pretty sharply. So I think there are various ways to play long-term duration because munis tend to be longer term and they tend to have high duration, and they tend to have a wider spread to treasuries. But listen, no one knows exactly where rates are going to go from here. But I will say that the 10-year, if you're a buyer of, long-term treasuries, you just had the 10-year go from 2.5 to 3 to above 3. So is it a bad time to add if if we go into a recession, right? The long end will be bid. And it just depends on the speed of how that happens. Now, arguably, there's been some decent economic data, lagging data, when it comes to payrolls, right? And it's been really mixed. It's really hard for people to see because we've had some really good data and some really bad data, right? Look at consumer confidence, look at ISM, look at outlooks on company earnings calls. Like that's all pointing negative. In the short term, we've had some good economic data. So it just depends on the speed of how quickly it's very obvious to everyone that we are going to a recession, and if that and when that happens, the long end of the curve will be a buy. But to say that it's a bottom, no one friggin' knows. None of these people know that are talking about it. They don't know whether it bottoms or not. When the 10-year was at 3.5%, I frankly didn't know it would bottomed it as either. I said it was a good risk reward, which is different than saying that something's bottom. So I just take it with a grain of salt when someone says, hey, we think the long end, we think long bottomed. No one knows if they bottom, but are they a better risk reward than they were when the 10-year was at 2.5? We frankly sold, literally like 8 a.m. one morning. I came out when the 10-year was kind of in the mid twos, and I was like, hey, we're selling our munis, we're selling all our long duration, and we'll come back to it. And it was a risk reward call. It wasn't that I knew that rates, that 2.5 was where rates were going to bottom. It was just that I thought the risk reward wasn't great. Given the labor, some of the data we were seeing, it wasn't as bad as quickly. And I still have a negative view on the economy. So eventually, the long end of the curve will be a buy. But to say that today, you know, rates have peaked or bonds have bottomed because rates are inversely correlated to bonds, so that the audience understands, not to confuse anyone. I don't think anyone really knows.
Thanks, I appreciate that, and definitely for putting it within the frame of the deteriorating economic data. It's bang on. Thank you.
Sure thing. And I think being positioned going into a recession with long-term duration credit with low credit risk, what that means is like low probability default, is probably a decent trade. But timing it isn't, are you going to time it perfectly? Absolutely not.
So
Nobody's going to time perfectly.
one
AJ,
thing
go
I,
ahead.
one thing I have been doing, I know you've been doing this. So I've been adding 1 year bond exposures. I know you're a big buyer in the two.
Oh, I've been buying the 2 year. The 2 year,
Yeah, I've
dude.
been buying. I've been
Ha,
buying the one. The
there,
one is the one rate, and the two rate is nominal. It's like it's been
yeah,
10 or 15 bips. So I've just been buying every time the one is creeped up over 3.2.
exactly.
I just make another purchase, and I make another purchase, and then I make another purchase. I made like I don't know 8 different sets of purchases in the past month. Again, like Jay's saying, you're not gonna waiting for the perfect equity bottom or waiting for the perfect bond top or bottom, whatever you want to call it, right? Take advantage of the data that's in front of you. So I just been piecing at the 1 year. I saw your
Yeah.
2 year, but like I figured the 1 year is
Yeah. I mean,
the same risk.
the two
Yeah.
year is at 3.5%. The 1 year is at, around 3%. Buying the 2 year, when in the last 10 years has anyone been able to lock in and, assuming that you believe and you're not a conspiracy theorist that US treasuries are still a risk-free asset when it comes to credit risk, when historically have you been able to buy the 2 year treasury at 3.5%? Just to park your cash. It's not what I'm trading. But if you're able to park your cash at 3.5%, and you're able to buy, you go to Treasury Direct, and buy treasuries at these types of yields at the front end of the curve, and you have excess capital, it's a no-brainer, right? And I don't know how I could be more obvious about it. Chase is paying you 10 basis points on your cash in your checking account. So is B of A, right? Marcus at Goldman Sachs, all of the no branch, Capital One, American Express, all the no brand savings accounts or companies that have brokered CDs out of Utah that started these savings businesses, they're also paying like 1.7%, right? If you have cash in your check, you should have no cash in your checking account, right? Apart from emergencies, you should either have it, invested in something, with a good risk reward, or in something at the short end of the curve where you can actually make money. And for a lot of people, a lot of older people in the space who have a considerable amount of savings, putting, $1 million, in a 2 year treasury, is not a bad trade. And I don't care what you say about inflation, but you know, it's earning 3.5% is better than earning zero or earning negative 50% in crypto. That's my crypto jab of the day. But Darren, I think you had your hand up, and then going to Manskin again, and then Ritter.
Hey Jay, thanks for bringing me up here and letting us into your stream of consciousness on this Sunday. And as a fellow Goldman alumnus, I appreciate the way you navigated through Nancy's thoughts as well. My question, really just kind of stems from the semiconductors. So just going back to that for a second, for me. Maybe I was a year early into the cybersecurity and just semiconductor space. I put something into the nest there related to earnings calls and how often they're discussing cybersecurity now. My question is just related to the Chips and Science Act, right? That new one that just passed. You mentioned the cyclical nature of the industry. Do you think this new legislation coming out of Washington, will that be somewhat of a stabilizer to some of these names? Or do you think it is just going to, be part of that cyclical industry and not so much of a ballast?
Thanks. So the CHIPS Act, believe it or not, a lot of the semiconductor names actually don't benefit. So for example, like Intel is going to get some money out of the CHIPS Act, but I think Intel, Samsung, and TSMC are the three biggest dollar winners from this CHIPS Act, and every other company, right? So like AMD, NVIDIA, and Qualcomm, for those who aren't close to the semi space, and I am by no means a semi expert, right? But I do read 10Ks and for a living, and I do skim through data on it for a living. So AMD, NVIDIA, and Qualcomm, they only design chips, right? Whereas TSMC, Samsung, Intel, they actually manufacture chips. So by passing the CHIPS Act, Congress sees an opportunity to fund R&D for primarily chips manufacturers. So about 40 billion of the 52 billion is actually marked for chip manufacturing incentives for Intel, Global Foundries, Samsung, TSMC. 2 billion is set aside specifically for to fund manufacturing and other aspects of chips made with older technology that are vital to various weapon systems for our defense and other military applications. So that's 42. That's about 40. That's 2 billion, and then there's a further 24 billion of tax breaks for factory construction rounds. So I think very little of this is going to the the semiconductor companies that I think FinTwit's the most excited about, like Nvidia and AMD.
So
Got it. Thanks,
yeah,
Jay.
yeah, Jay said
Sure.
the point. So like Nvidia and AMD actually had the most sentiment run, and Jay hit the point perfectly, right? And I don't think folks notice that enough, and they keep talking about that. I keep hearing a lot about it, about this being a bullish sign for those two tickers. But like Jay said, you really got to just peel it back a little bit and realize that it's not really going to benefit them. Obviously, the news helped the run, but cyclically during September and October, on top of the market weakness that we have, they are the weakest time for chips as well. So, just keep that in mind as well. I think Ritter had a question.
Yep. If Ritter is away from his phone, we can come back. Mansion, did you have a question?
Sure. AJ, thanks again. So a couple of questions. I think, first is you mentioned you had about 55% cash right now, or something to that order.
Yeah, and that
It's
cash
a lot
is
of cash.
not like
Yeah,
cash in a
right.
account. Like
It's a
it
2 year.
includes like 2-year
Right,
treasuries.
right,
It
right,
includes
right, right,
NAV
right.
specs. It
Cash
includes
and cash like instruments
yes.
like T bills, 2 years. Um,
Yep.
and so, our first question is, at what levels, I'm not going to talk like specific stocks because that gets hard. Let's just talk about like general market levels, right? S&P is down another 20-30%. Do you start, really allocating that cash? Where do you think sort of it starts getting
Oh,
attractive
I
for you?
mean, listen,
And
regardless of what happens, if I could buy great businesses that I like that are down 30% from here, I'm going to do it. I'm
okay,
going to start building, right? Even if I do think we're going to recession. Now, the data is going to matter, and how we get to that point is going to matter as well. And believe it or not, when you get to that point, some people will be so scared that
right,
they'll do the wrong thing. But I just don't think this is the right time. After I know we've given back like 6-7% in certain indices from this bear market rally from June, but listen, I'd rather I was fading that rally, and for a little while it was painful, but I'm actually positive on all my hedges. I sold a ton of Apple at the money calls that I had, I had 3 weeks across 3 weeks. I had weeklies. I sold all those on Friday. I still have my index hedges, and I wouldn't go nuts buying stocks until we retrace this bear market rally and head lower.
Mm,
But
that's that's totally fair, but
I don't have an exact number.
right, but at like 20-30% lower, you'd at least allocate half your
Oh,
cash. So,
100%. I would be
okay,
foolish not to, because over
okay,
the long
yeah,
run, right, these good companies are going to continue to compound earnings.
fair enough.
I know there's some people that like to get attention by being like completely nuts and going 100% bearish, or going 100% YOLO, what they call it, the millennials or Gen Z people call it long options. I don't do either. I think you
Yep,
allocate, and as you get more data, you change your allocations, and sometimes you get a fat pitch, and I wait for those fat pitches, right? So there are a few fat pitches that were like insane risk rewards. So like Citrix gave you two opportunities where like Elliott, arguably one of the three biggest credit hedge funds in the world, literally says they're going to buy the company, and you had two opportunities to get in for a double digit arbitrage. SafeM, so, Sanderson Farms, right? You're buying an agriculture company at like 3 times EBITDA, trading at a 40% discount to peers. And because of the merger agreement, all its peers have rallied and it stayed where it is. If the merger broke, it would actually rally up, right? Fat pitch. You look at Tenneco, where Apollo agrees not only to buy the equity, but to buy the debt. It's not a great business, trades at a low single digit PE multiple, and but there's no financing risk. That was the only merger risk given, there wasn't really there wasn't HHI or concentration risk. And when Apollo is going to buy all of the debt associated with the deal, it's going through. So when there is a big fat pitch, or Digital Bridge when it converted from Colony Capital, when I realized that all of the debt at the operating subsidiaries, hotels, wasn't recourse to the parent, so they could default, they could go bankrupt at the hotel division and the nursing home division and use the assets at the holding company to convert into a digital REIT during the pandemic. That was a 600% rally in the common and 300 in the prefs while earning a 20% carry. That's a fat pitch. So you keep, like Seth Klarman, you keep, even in bull markets, 20% of your cash, because when you hit it, when you receive a fat pitch, that's when you can generate alpha and you don't have to sell out of your existing holdings. So I view cash as being a tool in the economic toolkit. So even if the market were to go 20, 30% lower and the Fed pivoted, there might be some times, like there were times in COVID where I went over 100% long because I was long closed end funds at like 20% discounts to 20, 30% discounts to NAV, where I was buying IG bond funds before the Fed announced that they were going to go absolutely nutso. And I thought that was just an insane risk reward. And I was loading the boat and I was buying prefs, like AG&C prefs at like 10. And I'm talking like double digit current yields and like 150% upside with book equity below you. Like those are fat pitches. And if we were to, I don't think we're going to see that type of a clear pivot this time. So even if the market were to go 20, 30% lower, I would still likely have 20% cash. So hopefully put that in perspective.
Yeah.
So I'll go from 55, to 20, 25. But
And
the
that's more fully invested for you. No, that totally makes sense.
that's more fully invested for me. And the longest I was 105% long. And that was in April of 2020.
Yeah, and some of those were like arb plays, right?
Some of them were our plays, so
Yeah, yeah,
I didn't really foresee a lot of downside in
right,
them.
right.
And
and and, and also curious, Jay, as to like, do you think sort of as interest rates are moving up, how do you view sort of businesses that have net cash versus, obviously you're not gonna want to own over businesses, but just cost of financing going up and hitting the bottom line. Like, how are you viewing, debt and like cost of debt as you're sort of looking across the.
yeah, so I think the cost of debt is actually going to go up from here. And I think that the cost of debt funding is one of the reasons why Powell was so freely, he gave those three economic examples and he referred to Volcker in his speech, because when the credit spreads, Bank of America credit spread, Barclays credit spread, which used to be the Lehman which used to be the Lehman index, which used to be something else, like all these indexes, which is now the Bloomberg high yield spread. These spreads show you what the market implies for a probability of default for a company. So the higher the credit spread in the high yield index, the more the market is implying that you need to get paid for companies within the index defaulting in the future. And that is a forward indicator on layoffs and bankruptcies, right? So the Fed, and the New York Fed especially, looks at this data. They look at high yield credit spreads. So we went from less than 200 to 600 in June when the market was freaking out, to 400, and now we're back at 460. And like I said in the beginning of the space, I think a number of investors expected to blow out past 600 again. And in recessions, we've seen this spread get as high as 900. One reason why a mitigant to that is during COVID, a lot of companies refinanced and they pushed out maturities to 2025, 2027, right? Even like the Carnival cruise, like all these companies that increase leverage by like 100, 200% during COVID and will arguably never pay it back. You can kind of see my position on cruise lines through what I just said. A lot of these companies, were able to push their debt so far out. That's why their market caps haven't been decimated, because they're not going to default right away, because they have still the ability to service their interest expense. So I don't think you're going to see default. I think S&P's increased the default rate from 1% to 3% expectation. I don't think you're going to see double-digit defaults in this economic cycle, because of the fact that there's a lot of cash on the sidelines. There are a lot of private credit funds, high yield credit funds that are salivating for this opportunity, and maturities were pushed out. But arguably, I do think that the debt cost of capital is the Fed actually wants it to go higher. They want aggregate demand to go down, and they want monetary conditions to tighten.
Right. And so that makes, a business, for example, and you're just calling it a big company like Microsoft super attractive, right? Where, they do have a net cash balance versus, some of the other more.
Oh, 100%. It goes
Yeah.
to the beginning of the space. Companies with cash and that generate free cash will actually trade at premiums to the unprofitable tech companies, no matter how fast they're growing in this type of monetary environment. But I don't think many people are covering nuclear on the street. I think it's actually, and it's a good segue to spend a little bit of time on how the electricity markets work. I think that nuclear is the future because we need a form of baseload power. And what does that mean? A lot, traditionally coal was over 40% of our power supply, and a lot of coal plants, in 2012, 13, they were forced to put on, sulfur scrubbers, and the profitability went out of the money, and then with further regulations, they were decommissioned, and over time, there's no replacement for coal, right? Natural gas is only marginally successful because of the fact that most of the peaker plants are, 40 years old or more, and they're not efficient, and they're only in the money during very high demand periods. When your ACs are on full blast, that's when those peaker plants are really generating power and are contributing to the grid. So a lot of power generation has been built in Germany, places like Texas, in the form of wind farms. Okay. And those wind farms are definitely, in some ways they're good for the environment, but it actually takes a lot of energy to build a wind farm. And those wind blades can actually be recycled, right? So a lot of, ESG, I think, is fraught with a lack of understanding and a lot of marketing fraud that goes into pitching these projects so they raise money. They're not as clean as they appear. I like the idea of geothermal, but to build geothermal on a grand scale by harvesting heat within the earth, I think it's difficult. And when it comes to solar, I think that solar is kind of cost prohibitive, and without battery technology, like large scale battery technology, there's not enough lithium in the world to build battery plants that are large enough to store that much energy overnight to make solar a form of base power. So this, essentially comes around to, nuclear and the power grid. So nuclear comes under, a bad rap because, it is, there are a couple of big, when you look at what happened in Japan in 2011, when you look at, a couple plant issues they had with plants in Europe, and in Russia, what people don't understand is, the issues that we've had in nuclear are with 60, 70, 80-year-old technology. And the technology today, one, nuclear is the cleanest form of fuel. We have better ways to control, stabilize, and dispose of it today, or in a managed way, than we had in the past. Um, and I think that this is an out of consensus call where, I don't want to blame the sell side, but the sell side, because they're not paid, they're no, like, apart from you, like the large utilities, right? Like Constellation Energy, right? Like, I thought Constellation Energy was a great buy. It's a great company, and it would benefit from power prices. They generate nuclear, hydro, wind, and solar energy in the United States. The ticker is CEG. I think the thesis is already played out. But apart for companies like Constellation Energy, there's no way for the sell side to get paid pitching nuclear. Do you understand? These guys are paid because they raise equity and debt on behalf of issuers in the capital markets. And if there's no way for a bank to make money on the investment banking side or the capital market side, where they make most of their margin, the equity research side, has been a money loser for years, right? Because nobody pays you directly for your research on the street anymore. They pay you for trades, and you get the research for free, right? So because of that, a lot of the guys on the sell side research side don't cover nuclear. And I think it's to their detriment because they're missing the early innings of a multi-decade growth in nuclear. I mean, you saw Kishida, who is the prime minister of Japan, just last week say that they're restarting 7 nuclear plants. Where after 2011, I mean, hundreds and thousands of people lost their homes in Japan after the disaster, the nuclear disaster out there. So for Japan to say that we're so desperate because LNG prices at $87 are so high, per MMBTU, that we are going to restart 7 nuclear plants just tells you how desperate the world is for energy. And there are nuclear projects being built right now in India, in China, even in the States and in Eastern Europe. And I think it will only grow from here. And for anyone who wants to look up the Fukushima disaster, you can just Google it and you can see how terrible it was and how much of a leap it is for Japan to come out 11 years later and say they're restarting 7 nuclear plants very soon. Well, if there's drought, are we going to be building that many more hydro plants? And if river levels around the world are falling, it's in Yangtze in China, the Rhine in Germany, the Danube in France, Colorado River, all in the U.S. All these water levels are falling, right? So it's harder to build. It's harder to build hydro today than it was before. But arguably, hydro is the cleanest form of energy. I agree with that. But Danny, you had a question before we go on to the further into the power topic.
Yeah, I kind of have a different way of long term. I'm usually 40% long and 40% short, so everything's hedged. What do you think about that?
That's interesting. So you're like
And then 20% cash.
You're like a mini Millennium Pod.
Yeah.
So are you doing factor exposures? So for example, are you long Pepsi, short Coke? Are you factor neutral, or are you
No,
just alpha longs, alpha shorts?
Yes, I look for the overvalued companies and short them, and undervalued companies and long them.
Yeah, I would just say that over time, like people who do that successfully, and maybe you do it very successfully, I don't doubt it. They have big teams and do a lot of research, and they're fighting for like 300 basis points of alpha for trades that they're making during earnings. And hey, if you're levered and you're doing that, you can make a lot of money. Like that's how Ken Griffin is levered 11 times, long short, and Izzy Englander at Millennium have made all their money. So it is a way that people make money on the institutional side, but it's a lot of hard work, and over time your longs are going to outperform your shorts. So
I have like a PayPal and Square for short.
Yeah, and, those have worked out really well over the last 18 months.
QuantumScape also from like the highs.
QuantumScape was a borderline.
Yeah,
I won't even have to. I won't
and
even
I
say
longed LAC, the lithium company.
Yep, because LAC, Lithium Americas Corp. For those who don't know, actually, trades at a at a $3.8 billion valuation, and it is a relatively speculative name as well. But I guess your strategy has been to short pandemic beneficiaries and to go long your own version of energy companies. Is that right?
Yeah, a bit of a
Do you like
mix,
Livent? Because I was looking at Livent, and Livent actually has actually generates, it's going to generate about 400 million of EBITDA next year versus LAC. Do you have any view on the two?
No, actually, I didn't take
That's
much.
that's
due diligence into
LTHM.
Yeah, I didn't look so much into that.
Yeah, maybe it's
that was a
something.
new IPO, right?
Yeah, it was.
Yeah.
But even though it's a new IPO, it is more profitable than LAC. But
That's true.
I would just
I've
look
seen the
into
stock going crazy, but I didn't take
Yeah.
much.
Cool, man. Well, thank you for that. Sager, did you have a question?
Yeah, thanks, Jay. On China, aside from the economic slowdown and other issues you already mentioned, can I ask your opinion regarding, since now that China and US have agreed on the audit issue, I have, the stocks have rallied a lot, but I've been concerned, couldn't this actually be another added risk, possibly because the Chinese companies might not pass US audit requirements? Could you speak a bit about that? Thanks.
Yeah, I mean, this has been like a 3-year issue. This is a 3-year issue. A lot of these Chinese companies have underperformed. In fact, Baba actually did. Masayoshi-san at SoftBank, has actually been offloading a lot of stakes in companies. And, one of the reasons why Baba sold off is ahead of these listing requirements. They're like these synthetic tax trades where ownership of the actual security was given to the brokerages so that the party that's selling won't have to pay taxes. And these guys were essentially hedging their exposure in the options market. So I think that a lot of the risk of the delist has been priced into the market. That doesn't mean that when the delisting actually happens, that there isn't further price risk. But a lot of these companies, it's not like they're going to go away. They're just going to be listed in Hong Kong instead of the U.S. But on Friday, the reason why, not Friday, earlier last week when KWeb rallied, there was a rumor that there was substantial progress being made in China, essentially placating the U.S. when it came to their disclosures. At this point, there's not enough information to say, just like with the Iranian oil deal, right? There's not enough information to say whether this will, wow, futures are actually down. Small cap futures are actually down 1.6% now. I just got an alert on my phone. It goes under 1.5%. And NASDAQ's down 1.5%, and S&P's now down negative to 1%. But
the 2-year just hit new high since 2007. It crossed 3.5%.
Nice. For any savers that want to, it's there are two sides to every market movement, right? If for savers, that's a good thing. But I'm sorry, I lost my train of thought. Your question again?
Oh, you were answering basically if you think the Chinese companies would actually pass U.S. Required audits.
I think that is as unclear as this. It's more unclear than this Iranian oil deal. I don't trust I don't trust Chinese regulators, and it's only to their benefit in this specific scenario to work with the U.S. But these companies haven't been disclosing things for years that they will now have to scramble to disclose. And are they going to have to disclose things that the Chinese view as security risks? It is a bigger issue than it's a more complicated issue than the surface makes it seem. So until I see more data and I see a plan on a timeline or how these Chinese companies are going to meet US listing requirements, I would just take it with a grain of salt and I wouldn't put all my chips on the table. I know a lot of investors, traded KWeb and then they got really hurt on Friday. And was that an opportunity? I'd say it's early to see, but if you want to have a little bit of exposure, there is a chance that you get some good news. Is it one of my core trades? No, absolutely not. So hopefully that's helpful.
Yes, thank you.
Okay, great. And Leonard, you're up here. I wanted to see if you had a question or a comment. If Leonard is,
I'm here. I'm here. I'm
oh,
sorry.
you are.
I was in
No
the middle
problem.
of a tweet right now. I'm really Nancy Thomas or whoever NNT ran off, but I was going to try to answer a question for them. So
Please do. If we'll try to keep it because it's not a crypto space. We'll keep it to maybe less than a minute. But I'm happy to hear.
That's fine. Well, I just put a tweet in the nest, and I've been around for 11 years, and I've read like hundreds and thousands of white papers. I've experimented with other protocols. I've mined other protocols. I've played with them, and the extended history is that they always go to zero against Bitcoin, as you can see in like the charts that I posted above. And so the idea that ETH has a larger community of teenagers, who don't understand much about markets. And time will be proven out again, just like it was with Litecoin, just like it was with OneCoin, just like it was with every other thing that came before. And currently, ETH is going through a horrible phase where they're about to be captured and let go of the mining that actually secures their network. So I guess that's really all I have to say. I'm going to add to this tweet, and if anyone wants to read it, you're welcome to.
Yeah, anyone who wants to learn more, thank you, Leonard, for sharing that. And then we're going to go to our topic on the power markets and the energy markets. So I'm not going to spend a lot of time on that, just given where we are. But we'll have a series. Let's call this U.S. Electricity Markets 101, and we'll go on to U.S. Electricity Markets 102 in the next spaces. So in the U.S., um, think about how you buy electricity. Electricity is bought and sold in various regions in the US. And I posted this tweet that I'll put back into the space, but there are 7 different electricity markets in the United States. You have the California ISO in the West. You have the Southwest Power Pool, right, for states like Idaho, Nebraska, Arizona. You have the Electricity Reliable Council of Texas, which is called ERCOT. You have the Mid-Continent ISO. You have the PJM, which is Pennsylvania, Ohio, West Virginia, New Jersey. You have the ISO New England, which is where I am, and you have the New York ISO. And every single one of these power markets operates a little bit differently and has different rules, has different capacity payments that are paid. The only like true market for power prices in the United States that are the closest is Texas with ERCOT. And you can see how the volatility in power prices. I just posted, this image to the top so you can see the different power markets in the United States. You you know you can see that grid instability, can produce a lot of havoc. Like hundreds of people died, during freeze-offs in Texas because of their underbuilding of baseload power and over reliance on wind. So that provides you, kind of a high level of background. And, while many cities are served by municipally owned utilities, and some rural areas are served by customer-owned rural cooperatives, most electricity customers in the United States are served by utilities that are owned by investors. So these investor-owned electric utilities are regulated, and they operate as vertically integrated monopolies with oversight from public utility commissions, or they can operate in deregulated markets where electric prices are set by the market with some federal oversight, like in ERCOT. So these regulatory constructs determine how retail and wholesale electricity prices are set and how power plants are procured. So what we're going to go through right now is, a background on the traditional regulated markets, talk about the unregulated markets, and talk about some of the companies in the utility space, how they make money, how they're regulated, how rate base is put together, how you earn an ROE on that, why we are under invested in the US power grid. And ultimately, it's going to lead full circle, and we'll spend more time on why nuclear is the future in probably Electric 103. So probably in the space after next space. So I don't want to bore anyone. So I'm going to try to keep it short and sweet. But without understanding a background, a lot of what I discuss about nuclear and power isn't going to make a lot of sense. So prior to the 1990s, most investor-owned electric utilities were regulated and vertically integrated, which means that the utilities owned electric generators and power lines. So they had distribution businesses and transmission businesses. Today, only 1/3 of electricity demand is served by these integrated utility markets because many states have abandoned this system. So, so right now, utilities, like if you look at the XLU ETF, just to make it more exciting, and you look at the members of the XLU ETF, I would say that most of the members actually don't generate power. They actually are distribution and distribution transmission lines, and they operate and maintain those lines and are paid based on their capex and their maintenance for their maintenance of those lines. Companies like Constellation are is an example of a company that actually there are examples of companies that actually produce power, but those are only 1/3 of companies today. So utilities in traditionally regulated regions operate even today as monopolies, but because they're monopolies and they're regulated utilities, if you own transmission lines and distribution lines in the US, you have caps essentially on profitability. And I'll get to how the numbers and the economics work and the rate base system. But a monopoly means that your customers only have the option to buy power from you, that and for that right, you essentially get regulated by your local regulator. So to keep electricity rates reasonable for customers, state regulators oversee how electric utility monopolies set electricity prices. Retail electricity prices in these areas are set based on recovering the utility's operating and investment costs, along with a fair rate of return on those investments. That's collectively called a revenue requirement. These revenue requirements must be approved by state's Public Utilities Commission every year, which prevents utilities from overcharging customers for electricity. So regulated utilities also seek approval for power plant investments. Vertically integrated utilities decide which generators to build and then recover the cost of these investments through the electricity rates. Many state regulators require utilities to demonstrate, okay, the necessity of proposed investments through an integrated resource planning process called IRP, and that process is used for long-term planning and determines how much CapEx, capital expenditures. So for people who don't understand, how CapEx works and just quick income statement, right? Revenue minus gross profit, or revenue minus costs, or COGS, or cost of revenue, gets to gross profit. Gross profit minus SG&A gives you operating profit. Operating profit minus interest gives you pre-tax profit. Pre-tax profit minus taxes gives you net income. Okay, operating cash flow is essentially, your net income plus your D&A plus your working capital changes, and that is your operating cash flow. Your operating cash flow minus your capex gives you your free cash flow. That's a shortcut to get your free cash flow to equity. Okay, so what these regulated utilities are doing is they are earning on their rate base, on the collective capex that they've spent, using an IRP planning process. They're earning a regulated return on the capex they're spending. I'm trying to define terms as I'm going through so you understand what I'm talking about. And capex are essentially non-expense items. They're multi-year investments that you earn a return on. For example, you know, if you think about, just taking a step back from utilities, if you're building, a lemonade stand, from scratch, the construction of the stand would be a capex, but your cost of sugar, lemons, water, that would be an ongoing supply expense in your cost of goods sold. So let's go back to utilities. Even though vertically integrated utilities generate their own electricity, and please feel free to ask questions as I go along, many trade with other utilities during times of need. So, for example, during times of the year, it may be cheaper for some utilities to purchase excess hydroelectric power from others than generate power from their own facilities. This type of wholesale bilateral trading is especially common in the western and southeastern United States, where most utilities are still regulated. This doesn't include ERCOT. So the wholesale market transactions are subject to regulation by FERC. So when you see, a lot of times I'll refer to my tweets, I'll refer to FERC, the Federal Energy Regulatory Commission. These guys essentially regulate a lot of the bilateral trading in the power markets. So beginning in the 1990s, many US states decided to deregulate their electricity systems to create competition and lower costs. So this transition or restructuring required electric utilities to sell their generating assets, essentially their power plants, coal, natural gas, nuclear, and it led to the creation of independent energy suppliers that own generators, and then regulated utilities that own the transmission and distribution lines. Because these new independent power producers or energy suppliers could not cost effectively create their own power line infrastructure, the electric utilities held on to these assets. Some of them held on to these assets and became, hybrid transmission distribution utilities, which continue to be regulated. The biggest impact that resulted from the deregulation of the U.S. power markets were changes to retail and wholesale electricity rates, with the creation of retail customer choice in wholesale markets. So what does that mean? In deregulated areas, electricity customers actually have the option of choosing which electric supplier they have. So, like, for example, in New England, where we have Eversource, and there was a big power outage last week. I don't know if you were in Norwalk, Greenwich, Stamford, the Fairfield County area. There was a huge kind of AC power surge, and we were without power last week. But anyway, we have the right through Eversource, which is our utility, to choose, where we're buying our local electricity from, which utility we're buying from. So this introduces competition for retail electricity prices. Many electric suppliers then can exist within a region with customer choice, and electric retailers offer competitive prices to acquire customers. I'm also going to be publishing this electric power construct for subscribers if you want to read this, but I'm not going to go through all of it, and we're going to cut it short and talk about why we have issues with our power grid today and how this all led to it. So for consumers, there are pros and cons to selecting a supplier other than just your local utility company. Retail competition can help lower a consumer's electricity bill and allow them to tailor their energy use for preferences. So, you can choose clean energy suppliers, et cetera, when it comes to preferences. But independent companies often require customers to sign contracts. So when you do, when you're talking to utility, like I'm talking to Eversource, I'm locked in to that electricity price for a year or more with the, whichever electric power source I'm essentially using, right? And it's charged in dollars per kilowatt hour of power. And kilowatt hour of power is, how much they're charging you for power over a certain period of time, which in this case is an hour. So while fixed rates could be beneficial for some customers, they could also negatively impact others if the rate they agree to ends up being more expensive than the rate set by the local utility. So it's important to note that customer choice is only applicable for the generation portion of the customer's utility bill, because transmission and distribution services are still provided by the local utility company, and everyone's charged the same in that monopoly for the distribution and transmission, while the market part of that, so for example, if you're in Chicago and you call ComEd, the first in the original 30-second spiel they give you when you pick up the phone, they'll say, hey, we are not responsible for the volatility of natural gas and electricity prices. We are just the distributor and the transmission mechanism. And they say that because they're a natural monopoly, and they know, right, that people are pissed off about higher electric bills, which will get a lot worse this winter, gas and electric bills. But they are essentially supplying power from the independent power producers through their infrastructure to you. So let's talk about wholesale deregulation and the creation of competitive wholesale markets. So unlike regulated states that plan for investment, deregulated states use markets to determine which power plants are necessary for electric generation. But it's not pure competition. What has happened is, because of ESG, there has been, solar, there has been wind and other credits, like renewable energy credits, that have come into the picture, and these markets are not, pure competition. And for example, a lot of these utilities are now, they're getting subsidies for building renewable power, which is not necessarily a bad thing, but essentially it incentivizes more expensive power and less reliable power to be built at the expense of baseload power. Now, as utilities and competitive retailers in deregulated regions, don't regulate their own electricity, they must acquire power elsewhere for their customers as well. Centralized wholesale markets in which generators sell power and load-serving entities purchase it and sell it to customers provide an theoretically economically efficient method of doing so. Notably, under this structure, investment risk in power plants falls to the electric suppliers and not to the customers, unlike regulated markets. So following deregulation, regional transmission organizations, which are called RTOs, replaced utilities as grid operators and became the operators of wholesale markets for electricity. And the RTOs have evolved over time. I gave you the 7 RTOs earlier: California ISO, Southwest Power, ERCOT in Texas, Midcontinent ISO, PJM, ISO New England, and New York ISO. Since these 7 RTOs operate wholesale markets that encompass multiple states, they are regulated by FERC, with the exception of the Texas RTO, the Electric Reliability Council of Texas, or ERCOT. FERC has oversight over all wholesale power generation on the 2 large interconnected grids, the Eastern and the Western interconnects. While the regulated utilities base retail rates on a regulated rate of return of investments, deregulated retail utilities purchase electricity at market determined wholesale prices, and then they resell that electricity to customers at market determined retail prices. So these prices are not determined by the utilities, they're determined by the market given competition from other retailers. So RTOs typically run three kinds of markets that determine wholesale prices for these services. And one, energy markets. Two, capacity markets. Like in the PJM, there are big capacity payments that are paid to even non-profitable peak or gas type plants that shouldn't even be operating, and ancillary services markets. So again, RTOs typically run three kinds of markets to determine wholesale prices for power, energy prices, energy markets, capacity markets, and ancillary services markets. So energy markets, number one, are auctions that are used to coordinate the production of electricity on a day-to-day basis. So in an energy market, the electric supplier offers to sell the electricity that the power plants generate for a particular bid price. Think about like stocks, when you're trading stocks, there's a bid and an ask for a particular bid price, while the load serving entities on the demand side bid for that electricity to meet their customers' energy demand. So the supply side quantities and bids are ordered in ascending order of the offer price. The market then clears when the amount of electricity offered matches the amount demanded, and the generators receive this market price per megawatt hour of power generated. The RTOs typically run two energy markets. Okay. There's the day ahead and the real time market. In the day ahead power market, which represents 95% of energy transactions, it's based on the forecasted load for the next day and typically occurs the prior morning in order to allow generators time to prepare for the operation. So 95% of energy transactions in the United States occur in the day ahead market. Okay. The remaining energy market transactions take place in the real time market, which is typically run once every hour and once every 5 minutes to account for real time load changes that must be balanced at all times with supply. So RTOs, the seven I mentioned earlier, they use energy markets to decide which units to dispatch, run, and in which order. So in the day ahead power market, these RTOs, they compile a list of generators available for next day dispatch, and they order them from the least expensive to the most expensive to operate. So for example, since wind plants operate without fuel, they're able to bid zero into the energy market and to get dispatched first. This creates huge lack of fair competition in the energy market. So why do you think in places like Texas, there's been such a huge amount of wind turbines built, right? Since these wind plants operate without fuel, they are essentially the least expensive when they bid, and they're able to bid zero into the energy market, and they get dispatched first. So by dispatching units with dispatching in a purely competitive market, dispatching units with the lowest cost allows the market to meet energy demand at the lowest possible price. And during prices of high demand, these wholesale prices rise accordingly because more high cost units need to be dispatched to meet the electricity load. So base wholesale prices typically reflect the price for power when it can flow freely without transmission constraints across the RTO's territory. When that is not possible, RTOs account for congestion on transmission lines by allowing prices to differ by location. And as a result, areas with high demand and scarce electric resources typically have higher prices than those with abundant generation relative to load. So that's the energy market. That's the energy market of how the power business works. The next section is the capacity market. Okay, the electricity retailers are required by the North American Electric Reliability Corporation, which is called NERC. NERC is an independent organization that ensures grid reliability to support through generating capacity to meet forecasted load. So, if we had a purely competitive electric market, there'd be a period of time, like who would be preparing for above forecast load? Everyone would be trying to match marginal supply to marginal demand. But then if you had a big, power spike, like a heat wave, or you had, some forecasted load requirement that couldn't be met by the market, it would result in mass blackouts, right? So essentially, NERC provides, it's a regulatory body that focuses on maintaining grid stability. Some RTOs run a capacity auction that basically provides retailers with a way to procure their capacity requirements while also enabling generators to recover fixed costs, right? So a lot of like peaker plants and a lot of like less profitable plants exist because of these capacity payments in places like the PJM, and they're getting paid just to exist. So that if there's like a power surge or a heat wave or AC demand goes through the cliff, or that there are these peaker plants that that their maintenance capex and operating expenses are then covered, and their fixed costs are covered by these capacity payments. The capacity market auction works as follows. First, the generators set their bid price at an amount equal to the cost of keeping their plant available to operate if needed. Similar to the energy market, these bids are arranged from lowest to highest. Once the bids reach the required quantity that all retailers collectively must acquire to meet the expected peak demand, plus what they call reserve margin, then the market clears or supply meets demand. At this point, generators that clear the market or were chosen to provide capacity, they all receive the same clearing price, which is determined by the bid of the last generator used to meet the demand. So payments are to generators in the capacity market are essentially a reward for the generator being available to operate and provide electricity if needed. But the problem with this incentive system is that it's created hundreds and thousands of electric power plants that are getting funded by these capacity payments that are 30, 40, 50, 60 years old and can only provide, to the power market marginally when power prices rise high enough for them to be in the money. So the third part of the power market is the ancillary services market. And here, RTOs use the ancillary services market to reward other attributes that are not covered in the energy or capacity markets. Ancillary services typically include functions that help maintain grid frequency, provide short-term backup power if a generating unit stops. So it's not a big part of the power market, but just a caveat, not every one of the states of the 50 states falls into the 7 RTOs. Some regulated states with vertically, well, first of all, some states have chosen to embrace certain aspects of deregulation while maintaining some parts of regulation, and some regulated states with vertically integrated utilities still join an RTO for grid services, but provide other services as well. So in West Virginia, utilities are rate regulated and own their own generation, but the state will still participate in wholesale markets like the PJM, and then they also participate in the Mid-Atlantic RTO. Some states have deregulated their wholesale markets, but not the retail market. So California, for example, is partially deregulated and has its own RTO, the California Independent System Operator, CISO, which I provided in that graph at the top of the space, the map, which operates the grid in the wholesale markets. However, the state of California does not offer individual customer retail electricity choice. Although communities can opt out of the local utility through a community choice aggregation under which a company hired by the community buys power in the wholesale markets for all residents who don't opt out of this arrangement. So the structure of the wholesale markets varies across all regions, as we discussed. And the biggest market is ERCOT, which is the RTO of Texas, which doesn't run a capacity market and instead runs on price signals in the energy market alone. So they don't have a capacity market. It's mostly just this energy market where they rely on prices. And prices in the energy market, typically caused by low supply and high demand, provide an economic signal for more generators to enter the market, which can then lower energy prices and provide a signal that enough energy generating capacity is available to meet demand. But ERCOT has been lacking because of the volatility in temperature and prices over the last several years. The market mechanism has not been enough alone to meet demand, and there's been a lack of baseload power in ERCOT and in other RTOs because of these capacity payments. Older power plants have been paid just to be around, even though they're not providing baseload power. And ESG has created a system that rewards wind and solar over creating more sustainable long-term baseload generation like nuclear. And basically, the goal of this is that this needs to change in order to have a more reliable energy system in the future. And I hope I didn't bore anyone with this econ or this power price 101, but we're going to go into in the U.S. electricity markets 102 and 103. We're going to go more deeply into potential trades in the power markets and go into why we feel nuclear is the future, and which companies and products are the best positioned for that. So I wanted to leave it open for questions and comments, given given it's 9:13, and I think we're gonna wrap this up soon. And I didn't want to spend too much time, but hopefully, describing how the electricity markets operate in the U.S. Helped educate some consumers, because it tends to be, in the past several years, energy had been kind of a boring topic, and it's really now that power prices are going out of control that I think people realize the lack of investment in infrastructure, the way that incentives in our RTOs have created a system that is not well prepared for the future. And I think a couple people have requested here. We're gonna go through a couple questions. Misfit, go ahead.
Hey, so first of all, I just want to say thank you for bringing me up. Thank you for the space. You did a marvelous job explaining how the energy market works. I'm actually a developer, investor, and we also do some consulting in the space. And it's not an easy space to understand. It's very complex. It's highly regulated. Regulation varies from state to state, from country to country, and it's really very complex to be able to navigate it through all. And you did a wonderful job at explaining at it. And
Thanks, man.
you mentioned that you're releasing some sort of newsletter or putting all this together in a subscription.
Yes. So on my website, specialistsresearch.com, we're going to be providing a primer on how the U.S. electricity markets work. We have, over the past several months, provided examples of trades in the nuclear space. We're also going to be providing, over time, we're waiting for the fat pitches, but every now and then, as the market opportunity is created, we provide trade ideas through the service as well, where you're encouraged to do your own due diligence. And we'll provide full three-statement models and valuation scenarios that we have a team of 9 analysts, 5 data analysts, and 4 research analysts that put together these models and deep dive write-ups into individual companies. So that's specialsituationsresearch.com. And we're also going to be providing, people have asked me several times now to record the spaces. The spaces are recorded, but Twitter actually, after a month or two, the recordings get deleted on Twitter. So we're actually saving, and we're going to be uploading these spaces onto a private RSS feed and distributing our space discussions through Discord, which is available through our website, and there's also a Patreon. But through our newsletter, on our website, you will be getting an electricity markets 101 that explains the 7 RTOs, how power is priced in the U.S., what the different types of utilities are, and what our views on nuclear are.
This is great, man. I appreciate it. I will definitely check it out. And again, kudos to you, to the way that you explained it. It's really, really, I just want to emphasize on this, because it's a very complex industry, not easy to understand and navigate. And you explained it in a way that my 5-year-old kid would understand. So kudos to you, man.
Thank you, man. I really appreciate that. I'm humbled by it. Over the past several years, I have been part of some special situation trades in the energy space, where there tend to be a lot of like regulatory changes and lawsuits and issues and some of the parts stories that are interesting. But based on my background, I was not an energy analyst by trade. So I thank you for the comment. The compliment. I really appreciate that. Wanted to go to, so Chad, you've been waiting. I see you as a speaker. Did you have any comments or questions? Yep.
Hey Jay, just listening in today. Thanks for calling on me though. Great.
Oh, sure thing. Sure thing. I thought that you had requested. I appreciate that. And then, I think we're going to go around and just wrap it up. Wanted to see if Wolf and AJ had any questions. I'm going to essentially provide my views on the next week, the economic calendar, and some data points I'm going to be focusing on, and the fact that there are five Federal Reserve governors speaking next week. So I'll go through, what I think these five governors are going to say. Very briefly, and then we'll wrap it up for the evening. AJ, Wolf, did you have anything to share?
No, I mean, I think I really enjoyed what you covered. Oh, sorry. Can you hear me? I'm not sure if I was talking over AJ
Yeah,
there.
I can hear you.
Okay. No, I really enjoyed everything that was said. I think these spaces are really unique. You obviously do a ton of research over the weekend, Jay, and you come and present it really nicely on these spaces. So for everyone that's been tuning in for a couple of hours, I hope that they've been throwing you a follow, because obviously you're doing this on every single week basis. You're coming on spaces throughout the week. You're tweeting stuff. So this was very, very helpful, I think, for getting us set up, especially going into, the open tomorrow and just trading and having a feel for it, for everything from earnings to Fed speakers and so much more. I think there's a sense of kind of almost like a comfortability coming out of this space. So appreciate everything you do.
Hey, thanks, man. I really appreciate that. And AJ, I think there was a little bit of a sound issue on your mic. Did you have something you wanted to share, or any questions or comments? If not, I'll jump right into the economic forecast for this coming week. Not sorry, the calendar for this coming week. So tomorrow, August 29th, we have Dallas Fed manufacturing activity. So every week I provide a calendar to subscribers that ranks every U.S. economic output, or everything on the calendar, and I rank that 1 through 10 on how important it is to stock prices, because the real economy isn't the same as the stock market, and certain indicators have a bigger weight on the market than others. So Monday I don't think is going to be a big deal. Tuesday we have the FHFA housing price index month over month. I think that the market expects that to actually go up by 0.8%. If you look at the Zillow, the Zillow price index, for the first time in over 3 years, we saw a negative month. Over several years, we've seen a negative month, and the FHA housing price index actually forecast to be positive 80 bips. I think that we might see a miss there. 9 a.m. on Tuesday. The S&P CoreLogic 20 city month over month real estate index is also being released at 9 a.m. and that's forecasted to be up 0.9%. If the Fed is looking at all these estimates, maybe that's why they're so confident that the market still thinks real estate prices are going to rise. But I actually think they'll miss on the S&P CoreLogic as well. And as we're wrapping up, the couple other points that we think on Tuesday, Conference Board consumer confidence is forecast to be 97.7. We also think that will mess. Consumer confidence is a leading indicator when it comes to spending. Our economy is 70% consumer spending base, so that's an important metric. 10 a.m. on Tuesday. We also have JOLTS job openings on Tuesday at 10 a.m. On Wednesday, we have MBA mortgage applications. I think that will continue on its trend lower over the past several weeks. We also have ADP employment data that the Fed is definitely going to be looking at, with consensus expectations of 300,000 jobs. We have the challenger job cuts on September 1st. First of all, we have Chicago PMI, which is going to be around 52.5 according to estimates. It's actually strangely up from 52.1 in July. We would bet on the under for PMI, Purchasing Managers Index, leading indicator for manufacturing activity. Challenger job cuts come out on the September 1st, 7:30 a.m. Initial jobless claims is going to be aside for consumer confidence, initial jobless claims is going to be the most important metric that comes out next week. 249,000 jobs expected versus 243,000 jobs, jobless claims in the prior reading. So jobless claims, if they kind of stay in that 250 area, maybe it's higher than 249, but unless it's much higher, and I'm talking like 270 or higher, that's not going to be dovish. So if we see another like meaningless, and by meaningless, I mean, not one or two standard deviations away from 250,000, I think that's going to support the Fed's current stance after Jackson Hole. Continuing claims is also coming out at 8:30. That's supposed to be 1.45 million versus 1.415 million in the last print. S&P Global Manufacturing PMI is supposed to be 51. It's kind of like a flattish growth. Once that goes negative, it'll be more so indicating that we're in a recession. But that's pretty close to contraction at 51. Construction spending month over month is forecast to be negative 0.1. Wouldn't be surprised if that comes lower. It was negative 1.1% last month. ISM manufacturing is coming out on this first as well. A lot of economic information on September 1st. It's a first of the month. It's usually a big day. ISM prices paid. That's an inflationary metric. I would focus on that within the ISM data. ISM new orders is a leading indicator. And then finally, September 2nd, we have change in on-farm payrolls, which is very important, change in manufacturing payrolls, and the unemployment rate is going to be published. The unemployment rate is 3.5%, and the job openings, we have almost over 10 million job openings. That's why the Fed is being so tight in their monetary policy and being incrementally hawkish, because they're like 3.5% unemployment is the lowest we've ever seen it. So why would we be easing? Why would we be pivoting? I know that tech companies have announced 78,000 layoffs, and other other layoffs announced in the U.S. We do have a couple 100,000 layoffs that have been announced. So that's not enough to get the unemployment rate much higher, because there's so many job openings, right? So then we also have average hourly earnings on September 2nd at 8:30 a.m. So you're going to see, okay, how much are earnings, how much are wages going up? That's supposed to be 5.2% roughly. And the market's actually expecting that to be up 40 basis points, or 0.4% month over month. And then finally, we have factory orders at 10 a.m. on the 2nd, and durable goods orders. So that is, that takes us to Friday. It looks like we have a couple last questions, and then we'll wrap it up. And we're bringing AJ back up. He had some technical difficulties. No, he wanted to share something. So we'll go to Mila.f, and then go to AJ. And it looks like AJ still. Oh, AJ is up. AJ. So Mila, and then AJ, and Fury, and then we'll wrap it up.
Hi, this is actually Maya. So I was listening to you, and you were talking about the housing prices and Zillow going down. What is it, after 3 years? I live in Canada. Do you think any of those is going to be reflecting in Canada?
I'm not sure I understood the question. I am negative on Zillow, because Zillow, for those who don't know, Zillow is a tech-enabled real estate marketplace company. So they provide information about homes, real estate listings, mortgages through websites and mobile applications. They might make money on advertising. They also have a sales team that sells a premier agent subscription to real estate agents. So they make money on that, so on a subscription basis as well. This stock closed at 34 on Friday. It's a $6.5 billion market cap. They're kind of a pandemic beneficiary, but earnings in 2021 were actually negative 14 million on EBITDA. It's not very profitable. It is forecast to improve profitability, but I think you're going to see fewer real estate transactions. So that's been a headwind on the stock. Pull up the graph of the stock. It's come down from 100 to 34. Hopefully that provides a little bit of background on Zillow. I do expect, prices and the number of transactions, given where rates are, to fall in both Canada and the US. And we've been very negative on Canadian real estate prices since March. And we actually published a research piece on it as well. So, our view right now is that, places like Toronto, suburbs of Toronto, Vancouver, and suburbs of Vancouver were very overheated, and Canadian property prices were inflated because of foreign investors. And I think that prices continue to be very high, and there's a risk that they continue to go lower throughout the year, through the end of the year. I think prices could be down 20-25%. So
Was that because of the Chinese investors? I don't think they now have they're not allowed to do as much investment in properties in Vancouver. I live in Vancouver. I think they closed them. They just changed some laws for them.
yes, there were, even prior to the sell-off this year, there were, the bigger cities of Toronto and Vancouver, right? There were taxes, there were restrictions. What does that mean for incremental demand, though, right? Going forward, if there are taxes, penalties, restrictions on foreign buyers, that just means that there's going to be less demand for prices at these elevated levels. But I can spend more time on real estate on another space. Hopefully, but I'm happy that you provided that background. And AJ, it looked like you had some tech difficulties. Did you want to share anything?
Oh yeah, hopefully you can hear me now. It was just final thoughts, so I didn't really have a question for you. If you want to wrap it up,
No,
we
that's
can.
what I meant. Final thoughts.
Okay, hey, so yeah, thanks for hosting this as always. You cover about 6,000 more topics than I'm aware of, so I love learning from you as well every week. One of the things I wanted to highlight, right, and you already hit it. And so over the weekend, I wrote about watching the 2 year, 5 year, 10 year. They recently been bid down, so people were confused, and you can see that the bonds are getting bid back up again, and money's rotating back out of equity, right? The parity is continuing to go into that fashion. So. Kind of happy, kind of sad to see that happening already on the weekend, right? 2 year already hitting a new high since 2007.
The
10 years,
dollar, not only that, not only are you seeing
yep,
the 2 year, you're seeing the dollar strengthen, right? Which has
yep.
a
So I
tightening
wrote
effect.
I wrote about that too, about watching the dollar strengthen over the weekend in my little Substack. So Jay goes into 6,000 level layers of detail more than me, which is awesome. So I learned from him as well. But at a high level, folks who are in the room, if you're new to this, start learning the exposure of what a strengthened dollar means to the companies you invest in, and what it means to companies that have high beta versus low beta. Right. What I mean by that is beta of one is considered, movement with the market. Beta greater than one, which is ARC, which we like to call some of them shitcoats, are greater than one, so higher risk, higher exposure. And safer plays are beta less than one, right? So start to try to understand, is my recommendation, a strengthened dollar or weak, or a weaker foreign investments, whatever the case may be, how that impacts your company's exposure, and your company's growth, right? It's key to not just, hey, it has a lot of cash flow, or it doesn't have a lot of debt, and I think it's going to go up. Well, if it has a lot of exposure to the international market and the tailwinds are there for a stronger dollar, it's not going to go up right away, right? So that's kind of what I want to end with. I think I would love to do a space on that on the side, Jay.
Oh
Try
yeah,
to
let's
put
do
some
about it.
material together.
We can do something more detailed because we can go through. The tech companies in the United States tend to have more exposure. So right now there's 40% sales exposure for S&P 500 constituents to overseas foreign earnings, and when you have the dollar strengthen, those forward earnings come in lower due to the currency translation effect. So that there's a big issue for companies based in the U.S. that have foreign earnings. But not only that, there are implications for foreign investment as well. So this is definitely a topic. I actually had a friend that tried to quantify the impact of every 10% strengthening of the dollar versus the basket that he was using, and he was like, it is the equivalent of tightening 1.5% because it hurts our net exports and it hurts the U.S. Economy when the dollar is going parabolic. So it also is inflationary for other countries, and it makes it more difficult to pay back dollar denominated debt. So the stronger dollar is deflationary for the rest in one way. For companies that have debt denominated in the US dollar, but is inflationary because for countries that import a lot of their energy because commodities are priced in dollars. So it is a very interesting topic that we can spend time on. And don't forget, September 1st, the Fed's cap on quantitative tightening, it goes to 95 billion, 60 billion treasuries, 35 billion mortgages. I frankly don't think they'll get to the full 95, but just the signaling of that and to see QT and to see bonds roll off at a pace twice as fast as 2018 when QT resulted in credit spreads widening rapidly and stocks like Amazon falling 35% for admittedly what people thought was no reason in the third and fourth quarter of QT of 2018. For those who are not familiar, the pace of QT currently is going to be twice as fast as we saw in 2018. And we'll see. We'll see if the Fed allows the caps to play out as
Yeah,
they
and that's a great
estimated.
point. And the last thing I wanted to say was that the parity that you mentioned, the U.S. dollar, the Europe market, if everyone's not aware, all put together, not individually, all put together has more of a buying power effect in the United States, right? So what I noticed over the last week was the amount of bets that were placed on the Euro USD parity going to 0.95, 94, and 0.92, right? So there's a lot of money that has already been positioned that way. Now, that doesn't mean just because it's positioned that way, that's what's going to happen. That just means that the sentiment every week, and Jay's been pounding the table for months, every week is getting more and more and more bleak, right? So just keep your eyes and tabs on that, because at some point, whenever the trickle effects start to really rampage through the Europe economy, not